yum, whatever. Yeah, the next thing is. Exactly. And they were trying to tell me about
is each speaker gets 15 minutes, and then after everybody is done, we have a joint Q&A for everybody else. Okay? So,
all right, thank you.
Can
everybody hear me okay?
Yes.
Yeah, okay.
Yeah.
Well, okay. It's a pleasure to be here. My name is Luan Cox, as you said, and I'm the co-founder and CEO of a company called Crowdnetic. Before I sort of get into the crowd finance ecosystem and how we sort of define crowd finance, to talk a little bit about my background and also my co-founder's background and sort of how we wound up in this space. I personally have 15 plus years of experience in the financial data and web solutions business. In fact, I started my career in Mountain View, California, helping to build a company called Quote.com. For those of you who are over 40 might remember, we were the first ones to bring stock quotes onto the internet. We were Sequoia-backed. Mike Moritz was on our board. And people thought we were absolutely insane, because no way could normal people understand a stock quote on their own, which sounds sort of familiar now, because how in the world could anyone understand private equity on their own? And we just sort of got crazier and crazier. We bought stock quotes on the web, we bought research, news, and then companies like Schwab, E-Trade, Fidelity called us, and as they were sort of pioneering, as you know, the self-directed online investing world, and said, you know, we don't want to aggregate all this data, we don't want to build the front-end applications, can we just private label yours? And so we sort of invented cloud-based financial applications back in the 90s, before the word cloud was really being used. So I've built 4 successful businesses since then in the managed solutions data space. 3 years ago, noticed a website called Kickstarter. I live in Brooklyn, and 3 years ago, people barely knew who Kickstarter was, and I saw it. I just left Interactive Data, which is the 3rd largest data provider in the world, and grabbed my head of technology there and said, you know, this crowdfunding stuff is really cool. Let's take all of our technology experience and build a crowdfunding platform, launch a bunch of niche sites, and tie it to charity. And that was the first sort of premise for Crowdnetic pre-Jobs Act. And when the Jobs Act started to bubble up, I co-founded an organization called CIFRA, which is a lobbyist organization, and started meeting with the SEC and FINRA. And a light bulb went off for me, which was, you know, this is going to be a data nightmare. Another sort of light bulb went off as well, which is the problem of what we call deal flow versus distribution. So data nightmare, how are investors going to be able to research, analyze, compare across all these portals? Because a new asset class has just been born. And then deal flow versus distribution, how are these portals going to attract quality issuers and then also a repeat loyal investor base? And that's hard. It's called financial media. It's called retail brokerage. So we pivoted the company 18 months ago and went back to our roots and set out to build the only real-time market data platform for the crowd finance industry. And we define it, by the way, as peer lending, which we'll talk a little bit about, and obviously equity. We made history on October 11th with a partnership with Dow Jones, where, as you know, Title II was implemented on September 23rd of last year. 3 weeks later, on DowJonesMarketWatch.com, we launched the first ever private company ticker plant, if you will, and quote feed onto the investing and marketing and markets pages of MarketWatch, where 7.5 million people for the first time are seeing every day private company offerings, 506c offerings, side-by-side stocks, bonds, ETFs. We operate the largest educational resource in our acquisition of Now Street Wire last year, and we're also considered to be thought leaders in the event space. And our approach to events is much different than crowdfunding events that you might see. Ours, because of our background with Wall Street, with data, is really trying to bring in mainstream Wall Street into the fold and educate them. We held our first Crowd Finance 2013 event in partnership with Thomson Reuters, who was a close partner of Crowdnetic, back in December. Had over 200 people there, holding the second one on October 23rd. And I just got back from San Francisco. We own part of Lendit, which is the largest peer lending conference producer in the world. And just got back from San Francisco last night. This year's event was held on Monday and Tuesday of this week. We had almost 1,000 people at the event, which is 3 times what it was last year in New York. And then on Monday, we just launched our kayak for the peer lending space called Lenvious. So enough about me and Crowdnetic, but I hope you think we're qualified to talk to you, or I'm qualified at least. So we'll just go down to basics. What is crowd finance? And again, I mentioned we define it both in terms of stocks, equities, and peer lending / fixed income. And as a data and technology person, that's how we have to come about it, because not viewing it together is wrong, because it's crowd lending and it's crowd equity. And simply, it's not. I know the room, the demographic of the room understands it, but it's really just, anytime you're going to give something financial in return, it goes into the crowd finance world and becomes regulated as well. I guess how many? I'm not going to spend much time on Jobs Act, but just a show of hands. I mean, how many people are sort of pretty up to speed on Title II and Title III of the Jobs Act, which is most concerning in the crowd finance space? Wow, interesting. Okay. All right. So in crowd finance, and you could argue that Title IV, Reg A+, which we were not going to talk about today, could get into the crowdfunding space. But for today, we're going to talk about Title II and Title III, because that's most germane to our space. So Title II was implemented on September 23rd of last year by the SEC, and for us in the crowd finance industry, was a huge regulatory milestone, even if they screw up Title III, which we can debate later over drinks. Title II was significant because it removed the general solicitation ban on private capital raises. So overnight, on September 23rd, without even having to notify the SEC, which many did, by the way, but you didn't have to, you could start advertising your private capital raise on Facebook. And that's why we were ready for it. We knew September 23rd was out there. We reached out to a big partner. We reached out to AngelList, Crowdfunder, EquityNet. We're going to be bringing on RockThePost soon. So all of the large finance or intermediaries in the crowd finance space are publishing to our platform, by the way. We're not scraping data. And the idea is to be able to get that data out to the world, and we hope to be a conduit around that. So Title II was implemented. There are 3,000 plus companies on our platform and that we're aware of outside of funds who are raising capital right now under Title II, or trying to, at least. Why is it a big regulatory milestone? Because there are 8 million accredited investors in the United States. Most who don't even know that they're accredited, because you only have to make $200,000 a year. I say only, we live in New York. But yeah, 8 million people could actually invest in private companies, and only 300,000 did last year. So what does that tell you? That they either didn't know they were accredited, or no one came to them with the idea to invest in the next Facebook. And that's why Title II is significant. Obviously, Title III is much bigger. And under much debate, we're already hearing about Jobs Act 2.0. Regulators are already saying, whoops, we screwed up, it's not practical. We'll work through that together, but it's critical that we do, and we know that we will get there. And when we do, Title III allows everyone to invest up to certain amounts each year, right? So under Title II, you can advertise to the whole world. You can only take money from accredited investors. Title III, you can take money from everyone, and there's some things in there that will actually allow you to advertise. Implications. I mean, clearly, from an investor and entrepreneur perspective, it's a win-win. It's positive. Entrepreneurs, startups are starved for capital. This is a quick, I say quick, a quick relative to regular means way of getting their raise out to the world. And then obviously for investors who've been shut out from these opportunities for 80 years, it represents, and who are obviously not very happy right now with the public markets, represents an alternative asset class. And we think that over time, the private markets and even secondary trading in the private markets will actually surpass public. Because if we can set up the infrastructure properly, we won't have maybe the high frequency trading issues that we have today, and that's another debate we can have later. But it is, the securities industry, which means there's a lot of participants, and obviously much more complex than rewards-based crowdfunding. But we still think it's a win-win, and we think of the ecosystem. We just don't think of more lawyers getting paid or more accountants getting paid. We think of new businesses being born, and old businesses like accounting and legal being scaled for the masses. So if we look sort of on the top left quadrant of the spider chart, this really represents the expansion of existing financial services and legal services and accounting services due to the birth of and this is not just obviously in the US, this is a global phenomenon, as we know, of the birth of crowd finance. Obviously, more banking services, more accounting services, unfortunately, and no offense lawyers, more legal services, due diligence, and then secondary markets, which I'll talk again about in a minute. But it's important that we are proponents of secondary markets for no other reason for the entrepreneur's sake and the investor's sake, because clearly if an entrepreneur who's raising capital can also point to a real, possibly fairly liquid secondary market, then the investment risk from the investor may not be as bad. So we're really, and we're 2 years off from a secondary market that has, I think, any real volume, but it's important that it exists. And then on the right side, crowdfunding portals, crowdfinance portals, broker-dealers. And I mentioned the challenges earlier, and these challenges represent opportunities, by the way. I represent births of new businesses, but portals, broker-dealers, challenged with deal flow. And there's all kinds of creative ways to bring that deal flow in that people are coming up with, and then investor flow. And when we look at the market, we know all of the portals that are out there, the ones that tend to do the best, and we know them, and I have a slide on with some of their names, are the ones that already have sort of an existing network that allows for a curated set of deals that comes in highly curated, and more importantly, an investor network that trusts that company. Other sort of services that are coming about that need to be expanded for this space: due diligence, security. Obviously, companies like BankBox, security and escrow. Companies like BankBox creating ways to move money. Matching services. You think about it, but yeah, there's matching services in terms of investor to entrepreneur, but portals are really challenged with differentiating themselves. So a lot of them are doing things like helping find employees for these these startups, or offering advisory services for the companies post funding, and then secondary markets again. And the secondary market, just to sort of take a step back on the pure lending side, secondary market on the pure lending side is probably not too far away. That industry is 7 years old. It's already taken its hits from the SEC. And we think that the equity side of our world will just sort of follow pure lending. And it's hopefully not on the SEC side. We'll skip that part. But in terms of its growth. And then the sort of bottom half of the site is really sort of greenfield, in terms of what's possible in the birth, because of the birth of this space. If we look at it from a global perspective, we know that there's a lot of activity in Asia, in Europe, in trying to solve a problem, in terms of trying to solve problems about cross-border investing and helping each other. Crowd finance in Europe can't exist if France doesn't help Spain. You think that'll ever happen? But it's got to happen, So we're also helping there to the extent we can with the trade associations. But we'll see also consolidation in this space. I mean, there's depending on who you ask, there's 400 to 1,000 portals globally. Maybe this many are actually really viable. So we'll see some consolidation, and then we're already seeing it now. Angel investor networks coming on board, because they're not set up to sort of handle the incoming deal flow. And if you go back, if we go back to my experience in the 90s and the world of online online investing, that's where we are now. Just things that that have been done offline are being done online. And in the case of the angel investor world, which is not efficient in terms of how they handle internal incoming deal flow, they've thought about ways and come to companies like ours to figure out how can we manage more incoming and automate and distribute. And then on the right side of the slide, all of the new businesses that you could imagine that could pop up in the future. And for example, we wouldn't have Uber if there wasn't Facebook, right? And look at all of the social media businesses that have come out of Facebook. This is I think we're at the sort of the beginning of huge expansion in terms of types of businesses that are probable. around investor relations. You know, I don't know if there's any investor relations people in the room. Is there one? See? The investor relations industry has no idea what's about to hit them. And that's actually a quote from the CEO and head of the National Investors Relations Institute. They have no idea. They're not paying attention. But they will, and we'll have more scaled investor relations. It'll look much different, and you know, would be interesting to see. On the entertainment side, we're already seeing it. A&E doing stuff on crowdfunding. I think CNBC had a sort of crowdfunding Shark Tank. You know, there's Crowdfund TV. So the entertainment industry could change towards helping to either educate people on investing in private companies or capital raises. Transparency and trust tools. Now, you know, again, we're taking something that's very hard for people to understand because we still have an education ramp to get to. You're investing in, at least when you invest in a public company, there's a lot of public information, and we're trying to help with providing more. But at the end of the day, and as an investor and an entrepreneur who's raised capital, people invest in people, right? So there's a lot of interesting companies popping up around trying to create trust tools, reputational type tools, so that you're investing, you know, to follow along how people's minds work anyway when they're investing in a small company. Big data, overused term, but data aggregation, transparency, our business was born out of that. And then, you know, new cases obviously for the social web and how we leverage existing networks like Facebook and Twitter and LinkedIn to help raise capital for small businesses. And then, you know, co-working, you know, incubators, which we see a lot of them now, but we think that you know, the whole crowd mentality is about community and crowd. And when you start to sort of think about each other as, and you know about all the companies that are, you know, trying to raise capital or hire or whatever, we're starting to, there's no reason why there should be an empty seat at offices. And so I think we'll see a lot more. I mean, we've even talked about doing sort of, you know, co-working spaces just for crowdfunded companies. And then education and campaigns, and this is not just for the investor, but really for the entrepreneur. There are companies that are popping up that are just going to help you create your video, get your pitch together, and you can see how obviously this will go into the mainstream and PR and marketing. Companies will hop on board. So, and this, if we had more time, we could debate and discuss this for hours. So it's really, really, really exciting that it's not just for the investors and entrepreneurs. This is a revolutionary time for the entire sort of crowd finance or this financial services industry. But we can't really sort of talk about the ecosystem without talking a little bit about how we see the life cycle and how this whole revolution changes the potential life cycle of a company that's never been never been possible before. So what's not on this slide is obviously a company would start to get validation for their product on an Indiegogo, Rocket Hub, Kickstarter, right? And then what? So then they come into our world. And so you can imagine a company getting validation from Kickstarter, maybe coming into the peer-to-peer space. Maybe they still have a job, or they actually have some revenues coming in because of that, the pre-sales of the product, and going into the peer-to-peer space and getting a small personal loan from a lending club for right now up to $35,000, as long as you have a FICO of 640. And then coming back over, and that, you know, there's your $35,000. That's a lot of companies actually consider that seed capital, right? And lending club FICO 640 is actually stringent. You know, is actually very conservative as to who they loan to. There's a lot of other peer lending companies that will take other things into consideration. So there is money available, and you don't have to go and try to get it from friends and family at that stage. And then from there, coming over to the equity side, you have your product validation. You got you know, a small loan to get yourself out of that job, and now you can go and actually raise capital. And you're going to be in a better position to actually get that capital because of the validation and the fact that you quit your job and you're full-time and dedicated. And then you call your friends and family also and get in here. And then as you are operating and maybe have a little bit more revenues, maybe you come back into the peer side, over to the peer-to-business world. That's going to look at not only you, but your revenues and loan you money to grow or just to simply operate. And then if you don't live in New York or San Francisco or LA, or you could actually go back into a real estate crowd finance site and maybe buy an office and have an incubator or a co-work space in there. So you see how it all works together, and guess what's missing on this slide? Bank of America, Sequoia Capital, Sand Hill Road didn't come out of my mouth till just now. Well, good, I'm done. And I'm honored. I mean, I've drank the Kool-Aid. I've staked my entire life on it, and we just got to make this work. I'm honored to be a part of this industry. I'm so happy to see all of you guys. And if anyone wants to get involved and help, then come see me and I'll give you my card. So thank you.
Our next speaker is going to be Alejandro Cremades, who I consider a close friend, and is also, more importantly, the founder and CEO of RockThePost.
Can you all get back?
Harry, should you do 20 minutes?
Wonderful, thank you.
19.
All right, well, thank you so much, Professor Ghose, for having me here today. It's definitely a big honor. I'm going to try to jump right into what we're doing with RockThePost, right? Because I think that Luan was able to do a tremendous job explaining the regulatory framework and what comes with it. So, and as well, it's been a pleasure and an honor, to share the panel with Luan, because we've been pushing things, on the regulatory framework since we first met. I think it was like in 2012, 2011. So it has rained a little bit since then. Yeah, so just to talk about myself a little bit and to, walk you guys through my story. I'm originally from Spain, so thank you twice for not only for coming out of the lunch, but also for keeping up with my accent. I really, really appreciate it. In fact, I'm a legal resident, so I will not be invited to leave the country, which is great. But I essentially came here when I was 22 after getting my law degree in Spain. I came to do my master's in international business and trade law, and then after that I basically joined a law firm. I did a little bit of the corporate America route. So there I was involved in high-profile investment arbitration cases. One of them was Chevron against the government of Ecuador, where there was $113 billion at stake. But during that time, really as a hobby, I started getting involved with the tech scene here in New York City. And I actually met my co-founder, Tanya, who was working at Fox News. And the funny thing is that when we started getting involved in this tech scene, we saw that there was a huge lack of structure on the seed investment arena. I remember that when we had a couple of friends that had this lack of access to capital and had to shut down their business, we said to ourselves, there's got to be a better way to do this, right? So I remember that this was 2010. The word crowdfunding didn't really exist. The Jobs Act was, God knows where it was at that point. And I remember that we went to our lawyers, and this was 2010, and we said, look, we want to build a platform that is going to be called RockThePost, where we're going to be connecting early stage startups with investors. What do you think? And they said, you guys are completely crazy. I mean, this is the legal mindset, right? They always, tend to put you on the worst side of the spectrum here. And they said, you guys are crazy. This is completely forbidden because of the Securities and Exchange Act of 1933, and you're going to be shut down in a heartbeat. So as you can imagine, when we came out of that meeting, the world was falling apart. It was the biggest rainy day for me ever. And, we are entrepreneurs in the end, right? How many of you are entrepreneurs? Raise your hand. So you're probably going to relate with the fact that we are stubborn people, right? So we wanted to execute no matter what, and we said, look, let's just launch a donation-based platform for startups where there is no contractual obligations between the parties and no securities being sold. So with that model, we launched on November 2011. We were just geared towards startups. We operated for about a year or a year and a half, and we registered 7,000 startups and raised hundreds of thousands for them. But what happened is that all of a sudden, on April of 2012, Obama came out of left field with the Jobs Act, which Luan explained very well. And that's the point where we said to ourselves, wow, we're going to be able to do this. Like, I remember my co-founder and I grabbed each other, and we were, like jumping up and down, of excitement and so forth. So basically what we did is we locked ourselves for about 6 to 7 months, figuring out the best way to do the transition. And on January of 2013 is when we announced to the public the fact that we were doing such shift. And in March is when we launched the platform. So regarding what I was talking about, this is what we saw. This is what we saw back in 2010, right? We saw that the VCs were only investing on the seed stage level 3% of the capital that they had. So we said to ourselves, this can't be possible. And the problem that we saw is that as time went by, the investors were getting even pickier, right? Because now what it is called a Series A, for example, used to be a Series C or so, right? Or sorry, just so that I explain right, because I had a little bit of food as well during lunch. Basically what happens is that, what happened is that, for example, what it would be a series, like now to raise money is harder because the investor is even pickier. So now if you have, let's say, thousands of users and tons of traction, if you're not monetizing well and already have, that revenue streams in place, then it's going to be very hard to convince these people. So that's essentially what we saw. And essentially as well on the site that we've been able to build, the investors that come on board, it's basically seed stage. So the type of startups that you're going to be seeing on the RockThePost site is companies that the average round is about 700,000. You see between 250,000 and some exceptions of Series A's if they come with a venture capital firm behind them. But really what you see on the seed stage level is when the company is trying to assemble the team, which is the most important, and then obviously they need to operate in a market that makes sense and obviously have a prototype in place so that they can get things moving and kind of like translate those colors in the canvas as entrepreneurs to the investors that are going to be jumping on board, no? One of the other things that we saw is that the venture capital firms, in the end, they're knowledgeable people, right? And I have a tremendous amount of respect for them. But in the end, they are gatekeepers. It's kind of like the yes or no type of philosophy. The problem with that is that you see in this graph that 62% of them underperform with respect to the public markets. So what we saw with our site and with our service and with the operations that we're conducting is that it's much more powerful to actually do the crowdsourcing of the due diligence and have hundreds, if not thousands of individuals really come together in order to make a better informed decision. So the startup investing industry right now, as Luan mentioned, is just 8 million Americans, really. No, it's people that are either making $200,000 a year in income or that have $1 million in assets. The problem with that is that there is a big limitation, but even though that's the case, the market is still big. So just the angels and the VC industry alone, that's around $40 billion, and that's without counting the friends and family. Obviously, the friends and family, for the most part, is going to be non-accredited people, but that's around $100 billion industry. Just imagine if that would come together all in one, especially now with the Title III that Luan was talking about. What's going to happen is that just imagine that just 1% of the investments of every household in America would be for startup opportunities. That would be at least $300 billion. So, I think that we are right now just at the beginning. I would say that the industry, the equity crowdfunding industry where we're operating, is at the premature stage, at the early phase. But I think that once the Title III goes in and you start to see also the retail investors coming in and so forth with the limitations that obviously the Title III is introducing, it's going to be a pretty interesting market. So as you see there is 570,000 companies that launch every month in the US. As some of you know, VCs, for example, they only put like $1,000 checks, right? So let me ask you this. How many of you have heard of Pandora, the online radio? Please raise your hand. All right, well, Pandora was rejected 300 times before they were able to access a capital. So basically what we're seeing now is that imagine, if they would have given up on the 299th try, they would have not been able to do the IPO, create the, all the jobs that they were able to do. So, now really what we're doing is we're democratizing the entire process, because when you're investing in a startup, it's like you were saying, Luan, it's people investing, right? The earlier you go in the company, the harder it is to secure a check. So, it all comes down to the location, the vertical in which you're operating with your business, the round size, and also the ticket size. So imagine the waste of time to having to go, phone call after phone call with people to try to determine what's the deal with them. So, really the beautiful thing about bringing everything online is that all that is disrupted completely. Right now, like you just have to put your deal. Obviously, you need to put your first and second degree connections on board so that they help you to push and they believe in you and so forth, and you are able to showcase that. But in the end, you're going to get the project in front of the right eyes. So basically the way the startups get financed on the RockThePost platform is there's two types of securities that are being really sold by these companies. One is the shares, right? The equity. When you put a price round and you're selling equity of your company, for that route, you're going to need a well-respected institutional investor or a well-respected angel investor that is going to establish the valuation so that then you can go and raise the round. The reason why we do that is for protection, just like as a protection, as a safeguard measure for the investors that are coming through our platform, just in case you don't establish the valuation out of smoke, because entrepreneurs, we like to do that, right? The less we get diluted, the better, right? But in the end, you need to have a third party that is going to be doing that work for you, because it's going to establish trust and so forth, and to avoid down rounds down the line. And if that's not the case, basically what happens is that you're going to go through the convertible note route, and on that front, we're actually providing a lot of education and a lot of guidance to the entrepreneurs on the platform so that they're able to figure out what's the best way to, for example, establish the interest, the discount, and also the valuation cap to be able to raise such round. So the use of proceeds, really, as I was mentioning, the type of companies that come to the site already have a prototype in the market. They've already been a little bit up and running, and they, for example, raised, let's say, a friends and family round before. So that's really the way that you're going to be able to explain to investors what you're about, right? So as you see here, the use of proceeds that you're going to be seeing is basically going to be oriented for business development, to assemble a little bit better the team, and also for the market research, right? So the companies that you see on our site right now, we have a little bit of a variety. We have up to 50 companies that come to our site on a daily basis. That's pretty much more than any angel group that you could even imagine. And then as well, what you see here is the diversity, right? That you see on the type of verticals that we're covering. For the most part, it's tech, but then we have a little bit of consumer, and then the other type of verticals that have a technological component. So the way we do this is basically we have relationships that we've been able to establish with some universities, with incubator programs and so forth, and they're very helpful when referring deals. Because in the end, what we want to do is we want to make sure that people are getting value, because when a company comes to us, maybe they're at a napkin idea stage. So what we do is we call this the fundability score. When the company comes to RockThePost, we're tracking the traction, the investors, the advisors, the press mention, and so forth. And depending on the overall score that they get, they're going to be deemed as a fundable company or a non-fundable company. If they're a fundable company, then they will be going on to the platform. But if they're a non-fundable company, which not a lot of our competitors are doing, we're going to be putting them through an educational route in which they get access to business one-on-one materials, webinar sessions, and so forth. So in the end, really, they are getting value, even though they're not ready to be financed. But we're kind of like providing the guidance to get there, no? So overall, since March 2013, which is when we launched the platform, companies that have launched on RockThePost have raised 30 million with our help. And that's a little bit where we are. I really wanted to make this very interactive, so I really want to get those questions from you guys. So thank you so much for listening.
Thanks, Alejandro. And our last speaker for this panel is Mandie Holmes, who's an associate at Launch Angels.
So I must admit, looking at the speakers list and the list of topics here, I'm feeling a little bit out of place. I'm not an academic. I'm not an entrepreneur. I am that evil venture capitalist that you guys are talking about. So do mind me if I seem a little nervous here.
We won't throw it at you.
Well, I think you'll like me. So today I'm going to talk about how equity crowdfunding, or crowd financing as it's also called, is changing my role as a VC. And more specifically, I want to talk about a little bit of what I look for in companies who are equity crowdfunding, because that's what my company does. We invest in companies that are listed on RockThePost, on AngelList, on MicroVentures, all these equity crowdfunding platforms. So we take a little bit of a different bent there. And I just want to clarify that I'm going to use crowdfunding as shorthand for equity crowdfunding, crowd financing, but I'm really focused on the I'm investing in your company, you're going to give me equity. All right, so that's me. You can read a little bit about my background here, but basically the most important thing is that I'm a venture capitalist. Surprise! And so we source our companies actually both ways. We probably look at 90% of the companies we look at come from these equity crowdfunded platforms, and then about 10% of what I do comes from the New England area and the very traditional venture capital sourcing through my professional networks, through the various innovation centers and incubators and accelerators that exist in the New England area, and from referrals that I get from other venture capital companies. So I do get to play around in a little bit of both, and I think that gives me a good perspective on the types of companies that are out there and the quality thereof. So there's a lot of discussion on crowdfunding as a disruptive force for VCs, and there's actually a lot of hostility on the part of VCs towards equity crowdfunded companies. There's this idea out there that they're not as strong. They're only crowdfunding because they couldn't get the interest of venture capitalists, et cetera, et cetera. So that makes what I do a little bit unique, because we're actually a little bit of a hybrid between angel groups and venture capitalists. We raise small funds of $1 to $2 million. We raise them over the course of about 3 months, and then we look to deploy that capital, about 1/10 of it at a time, very, very quickly in companies that we find on these portals. And so our main, we have that goal of maximizing our ROI, but our main goal is to get equity out there from those 8 million minus the 300,000 active angels, get that fresh boat of capital out to these companies. And so, we covered a little bit about the entrepreneurial financing ecosystem, but in the previous presentations, but sometimes this graph is very helpful. This right here is where equity crowdfunding is having the most impact. These are companies that are raising $250,000 to about $1 million. It's a really hard space to get financing. Usually, if you're on the lower end of that spectrum, you can go to friends and family if you have the right network. If you have that rich uncle, if you have that rich grandmother, maybe you have that professor from a university who made some money in his own startup. If you don't have that network, or if you're looking to raise a lot larger amount of capital, you're going to angel groups. These are business professionals who are a lot of them are investing for fun. They tend to have expertise in a particular sector or area, and they've gotten together to pool their capital to invest in companies like yours. And it's a bit of a slog to go to these angel groups and get money, because they're looking at writing checks of $300,000, $400,000, and so they're going to do a lot of diligence on you. They're going to do a lot of research. It can take 6 to 9 months to get funding, and if you're a small startup just trying to get that product out the door, 6 to 9 months is a very long time. And so that can make or break you. So now I'm going to talk a little bit about what I look for in companies that are crowdfunded. And as it turns out, the fundamentals really do they apply to both. So we're looking for strong teams, early sales, market opportunity, all the stuff you look for in traditionally sourced companies. These investments are just as strong when they come through Techstars as when I get them off of AngelList. There's no difference there. The only difference between crowdfunded and traditional companies, as I'll call them, is that for a traditional company, I have a personal recommendation from Techstars, from Next Ventures, from an angel investor with a strong investment track record who I trust, who I know very well, that is telling me that this entrepreneur has what it takes to get them from that proverbial closet to Silicon Valley, or to that next big exit that they're looking for. So when I have that recommendation, when it's from somebody that I trust, I might accept the company to invest in that doesn't have early sales or user traction. I'm willing to take that extra chance on that company, and I'm not really willing to do that for a crowdfunded company. I'm actually much stricter on them and have much more criteria that I expect them to demonstrate. First of all, that early sales or user traction, that's very important, because with equity crowdfunded companies, I'm looking at companies across all stages and all stages of business development. For traditional companies, I focus on ad tech and mobile. That's what my background is in. That's what I know the most about. But for these crowdfunded companies, I've looked at healthcare device companies. I've looked at tech-enabled catering companies. I've looked at consumer products. I've looked at makeup. These are things that I don't necessarily have expertise in. So that early sales or user traction is very important for me to gauge product market fit. Strong advisors are also really key. Again, usually for a traditional company, with investors writing the size of checks that I'm writing these folks, they might ask me for mentorship, or they might ask me to sit on their board, or there's some way that I can influence this company in what I believe will maximize the ROI out of that investment. For crowdfunded companies, that's not the case. So I really have to trust that they've assembled the correct team around them, or at least what I view as the correct team and a strong team to guide them to that next stage of financing for them. Let's see. And on a related note, experienced investors are very similar. Again, because I'm investing in sectors that I don't know much about. If I'm looking at a healthcare company, for example, I'm going to take a look at who their investors are, and I'm going to go to AngelList, and I'm going to look up the portfolio of investments that those angel investors have. And if I see that you have a lot of investors who have invested in a lot of healthcare companies, that's a check in your favor. That's a little bit of trust that I now have in you as a company that I didn't have before. And I'll talk about social buzz and investor traction in a moment, but this reputable crowdfunding site, this is actually very important for me. And there are some crowdfunding sites like AngelList. They don't do any curation. Any company who wants to raise money can list themselves on AngelList. But there's a lot of other companies out there, like RockThePost, who do a little bit of curation. They determine whether or not their companies are actually ready to raise money. And so when I say reputable crowdfunding company, this means I've talked to the management team and I really understand what their diligence process is like, and what their curation process is like, what their criteria is for companies. I'm really interested in how selective they are, what additional resources they provide to their companies to, again, help them succeed. It's like that advisor base. And I'm also very invested in who's investing on their site, how much money they've raised, those kinds of things. And so, sorry, again, nervous. And so that's very important to me, and that's the first thing that I do before evaluating any company on a site, is really develop that relationship with the platform and understand their background. And I think it's something that I really recommend that any individual accredited investor who's looking at investing on these portals do. It's probably the single most important thing. If you're going to do nothing else, invest that time in diligencing your platform. And so kind of on that social buzz thing, I'm just kind of wondering how many people here are young enough to have had that realization in school that you could look up a topic on Wikipedia before you wrote an essay on it? All right, yes. So looking to social buzz for these equity crowdfunded companies is very similar. You do your initial survey on Wikipedia, and then you see what their resources are, and then, all right, now I know enough to go do some additional academic research and hit the library and that kind of thing. So, looking at press, social activity, and the questions that investors are asking these entrepreneurs, that's very important. That's my Wikipedia article on diligence, my additional research that I do on these companies. You can learn a lot that way, and you can learn, one of the big things there is how seriously are the entrepreneurs taking their raise. If they're very on top of the ball and interacting with investors a lot, then they're taking their raise very seriously, and maybe that's a good sign that they're taking their company very seriously too. There's also this added thing that social buzz tends to correlate with money raised. If you have a lot of social buzz, you're attracting a lot of potential would-be investors. The more would-be investors in the pipeline, the more eventual investors will actually give you money. And so if you're raising $1 million and only manage to raise $300,000, it's going to be a lot harder for you to hit those milestones that you need to hit to be successful. But if you have that social buzz, you actually raise the full $1 million that you want, then it becomes a lot easier for you to build that successful business. And so I definitely look for that. And this last one, the social buzz is particularly important for AngelList because they don't curate any of their companies, and if you're raising money, you can just throw up a portfolio up there. Social buzz is a way of testing the legitimacy of a company. If I'm raising money, the first thing I do is tell all of my family and friends and all of my customers to say, hey, talk about me. I go to the press, hey, talk about me, I'm raising money. And if you're not doing that, then that's a potential red flag that people tend to overlook. So I usually, when I talk, I'm usually talking to entrepreneurs and trying to help them set up their campaigns and this kind of thing. So, a bit more of what I do is very practical advice. And so this is my practical advice slide that if you're going to take one thing away, take away this. For for the investors, for the accredited investors in the room, angel investing is very, very risky. Even VCs who do this professionally, they have an abysmal record. I don't know what my record is. I've only been investing in equity crowdfunded companies since September. So it's going to be a little while before I can give you what my success rate is. But overall, on a whole, as an industry, we do very badly. And angel investors also do very badly. That's kind of why they're called angels. So, you can check off all of those boxes. You can have all this additional criteria for crowdfunded companies that you don't have for, that guy down the street who wants you to give money for his hot dog stand. But at the end of the day, it's risky business. And so sometimes it's okay to go with your gut. And you really believe in an idea and you really believe in an entrepreneur, write him a check for $50K. Why not? You're really helping these guys out, small businesses. They're growing the economy. They create the most jobs. They create the longest lasting jobs. They have the most impact. So, give back. If you're in that position to, just go for it. Why not? And then for the entrepreneurs, it's a lot of work to run the successful crowdfunding campaign. You can, from that start to finish, you can raise money in a few days and be done with it, but it takes months of research beforehand to target your investors, spending time on AngelList, Googling all the accredited investors who have the network that you want to tap into. And I think a lot of entrepreneurs forget that, so they'll just throw something up on AngelList and, well, why aren't I raising money? Why isn't this successful? Why am I having such trouble? So, do your homework. Crowdfunding is around because of the internet, so use that as a tool to set your campaign and set your company up for the most amount of success possible. And that's me.
So, why don't you guys just sit over there? All right, so we got about 10 minutes for questions, and I'm going to start out with a more open-ended question. And then I'll open up to the audience. So, as I hear more about equity crowdfunding and crowdfunding in general, right? Equity crowdfunding seems inevitable. It's sort of in many ways here. Title III is going to get enacted soon. So one of the questions that I often think about is the pool of investors who would go to equity crowdfunding versus the pool of people who've been going to Indiegogos and the Kickstarters, right? So it could go one of both ways. One in which you see a substitution effect that the regular crowdfunding platforms see an exodus of potential investors into equity crowdfunding platforms, or you could just see the kind of investors coming into equity crowdfunding platform being very different from the ones who go to Kickstarter or Indiegogo. So I'd love to hear your thoughts, and each of you can maybe share a little bit about that. Like, where do you see this going? Do you see a substitution effect happening, or do you see a market expansion effect where we actually see two very different sets of investors in these platforms? Because presumably after Title III, anybody below 100K can invest, up to 5%, right? So that is also that's also the segment of people who do invest in Kickstarter and Indiegogo. So, yeah.
Yeah, so, you want to take it? Yeah, so I would like to say to that donation-based and equity-based crowdfunding, they're two different types of animals. I would say that the communities are moved by different things, right? Because on the donation side, you're more towards opening your wallet and giving money once there's like a project or a cause that is really moving you to make such investment or such donation, right? On the equity crowdfunding side, and especially you have ideas, right? So it's not like that you have stuff that has already been developed and it's already in the market, getting some momentum and traction. And I think that like from that aspect, the donation base is obviously like the first step in the process. If you can go the donation based route and raise millions of dollars like the Pebble Watch did, do that, right? Don't go the equity crowdfunding route. The problem is that that's going to happen 1 in 50,000, right? Like all these projects that you see on the press raising millions of dollars, that's not really the case. What you see on the equity crowdfunding industry, it's more that you have already a prototype in the market. There is already potentially friends and family behind. Maybe there is like accredited investors, an angel group, or an institutional investor already pushing things. And it's more potentially the expertise that you have that is pushing you to be involved, to provide value to that company. Also, the possibility of returns on the investment as well, potentially, because yes, like what Mandie was saying is that these angel investors are angels, right? Because it's a tough space really to find the winners. 1 out of 10 is really going to be a hit. But the beautiful thing about equity crowdfunding is that in the end, as an investor, you get to diversify the risk and to hedge your bets, because instead of putting $100,000 or $50,000 like a company would ask you in Silicon Valley, now you get to invest that $100,000 into 100 different companies. So obviously the possibility to reach success with a company, it's actually increasing. So that's just my 2 cents.
I think part of the question was, is it the same user? Is it the same user that's going to Kickstarter? Does that translate over to the equity space? And I think absolutely. I mean, just look at Oculus, and all the stuff around that. And at the end of the day, people are going onto these rewards-based sites because they want to see this product come to life and they want it. I think that same user follows that company into an online capital raise. I think that was part of your question.
Mm-hmm.
Yeah, and if you look internationally where they don't have these restrictions on, they don't have that line between accredited and unaccredited, you don't actually see a lot of population differences between who's participating in the crowdfunding campaigns versus the equity crowdfunding campaigns. There's a lot of overlap. But until there's a lot more clarity on unaccredited investors and a lot less restrictions on the individual startups who accept investments from unaccredited investors, I actually think there's going to be a separation of who is willing to participate in that. At least talking with startups in the Boston area and helping them with setting themselves up for these equity crowdfunding campaigns, it's not worth their while right now to accept unaccredited investors under the current regulations proposed in Title III. It's just not worthwhile. So at least from a regulation perspective, we're going to have that divide in the United States for a very long time.
And just a quick point to add, there is companies and ideas that are going to do very well in the donation-based crowdfunding, but not that well vice versa, right? Because, for example, as I was saying, really, there's like when you go into the donation-based market, it can be the project or the cost, but then as well the fact that you might be getting that product in exchange, right? The problem is that when you put like a tech startup, out there, what type of, a tangible reward are you going to be able to provide to the backers, right? So that's kind of like a little bit of an obstacle. So those companies would tend to do better on equity crowdfunding.
Go ahead.
Maybe this is for the ex-King and Spalding person. Are most of the companies using a traditional private placement memorandum that, let's say, King and Spalding would have prepared with all kinds of disclaimer languages, why you should invest, et cetera, et cetera, et cetera? Or is it more of a business plan approach that they put up on the internet? And so you go with the business as opposed to the legal disclaimer document?
Yeah, so obviously right now, it's very important for us to not get too much involved on the negotiation process and on how, like the deal really happens. We don't want to create precedent, right? Especially with the Title III that still needs to come out. We're trying to provide as much as curation as we can, but really the way it works is we are connecting people, right? We're the bridge between the startup and also the investor, but we don't want to get too much involved with, the PPMs or what part of the process is going to happen. We're really connected.
Are they using PPMs or are they using business plans?
They're using.
You're shaking your head.
They're using business plans.
Well, I mean, business plans, pitch decks, I would call it. I think that now when you tell to an entrepreneur business plan, they would probably throw their hands to their head, no? Okay. But yeah, I mean, you have the slides. Like on our site, really the way it works is you have the pitch deck, there where you can find the slides. You can also find more of the offering materials on another tab within that venture profile. So we're trying to provide, I mean, the goal for us, for RockThePost, is to provide as much information as we can, right? And we're encouraging our entrepreneurs to do that so that, in the end, the investor is able to make a better informed decision. So the more information, the better.
Yeah, that's actually something that's very dependent on the individual platforms as well. There are some platforms that do provide the PPMs and the very detailed investor docs, and there are some that it's just the business plan, it's just a pitch deck. So it depends on the crowdfunding portal itself.
But I would say, at least 90% of the companies that are out there don't have a PPM or a subscription booklet prepared, yet. Yeah.
There's a question over there.
Yeah, question. Mandie, you're talking about how different level of trust you have with someone who's offline introduces you to investments when you trust personal crowdfunding. And our experience was very similar raising capital. We were pitching first round capital in 2009 and they didn't respond. In 2010 they responded. And then in 2012 we pitched them after we'd already done our seed round. And David Cohen from Techstars was the investor. And he made the introduction and then they invested. And I always tell the companies I advise, I say it's more important to have a great introduction than it is to have a good pitch. I mean, because then they'll at least open their ears and they'll at least be open to the pitch. So how do crowdfunded companies, I don't know, I mean, and we got lucky with David Cohen because he became very involved and trusted us and was vouched for us. How do crowdfunded companies fare in going for follow-on capital? If they do or do not, I don't know if they have a strong lead or someone that's very involved in their company who's willing to vouch for them and make the introductions to the next level.
In terms of follow-on capital, are you saying follow-on to a crowdfunded round or just in general?
They do their seed round and then want to do the period.
It's a little bit young for that. It really depends on the VCs that you approach. There are some VCs who are very much of the opinion they will never invest money in a company that has raised capital via crowdfunding. And crowdfunding is so young. I think those attitudes are going to change in the next couple of years as we see more of the Oculuses happen. But I think that personal connection still remains very, very important. And just because you crowdfund doesn't mean you can't tap into your investor network that you raised via a crowdfunding site. People like David Chang and other really well-respected angel investors are doing the traditional angel thing, and they're also crowdfunding at the same time. And they're talking about their investments and they're putting them up on angel list, and they're doing that so that companies like yours who may or may not be crowdfunding, they can help them make those connections to the next round. Because really, when it comes down to it, a company that has an easier time with that follow-on fundraising round is just going to have an easier time growing their business and running their business, and it's better for the ROI of everybody all around to facilitate that process.
Sure.
And I think we're going to see an evolution. I mean, AngelList and Naval Ravikant sort of started it with the syndicates model. But from our perspective, we're really thinking about what can we do around providing investor information, so that, and then creating sort of investor networks. So taking the sort of AngelList syndicate idea and expanding it further. So we think that like the evolution could be that there is sort of this these funds or individuals that are going around RockThePost, other sites. People are able to see what they're investing in. So. And get that credibility. So one person can bring around the crowd. That one person too could also bring them to the next level.
I think there's a very good phrase from Dave McClure here that he says that he doesn't care where the deal is coming from as long as it's a good deal. And I think that and it's funny, like the message that is put on the press and all that, because in the end, like for example on RockThePost, we have people like Tim Draper that is backing one of our companies, Bessemer, or we have like great investors. And it's funny, like this kind of like message that is put out on the press. I think there's a big lack of education of what really is happening on the industry. And many times, like when I'm at a conference or even in my office, I have like people that are VCs that tell me, Alejandro, which one is the good deal? I'm like, look, I can't tell you which one it is. But like in the end, like they want to know where the crowd is going. Where is that engagement? Where's the interaction? Because in the end, that's going to be a good deal.
Question over there. Last question.
My name is Steve. I have a question. What trends do you guys see in brokerage firms?
I can answer that because we have a broker-dealer that sits in our office. Yeah, I mean, this is the financial services industry. A broker-dealer is required to be behind these portals. And so we've got companies like they're already there. We have CrowdClear, we have WealthForge, which I believe you guys work with, North Capital. So there's some with grayer hair than others, but there's already there's a support system there, and some of them actually are already positioning themselves to provide the clearing and settlement later for the secondary market. So they have to be there, and they are there.
All right, so we'll have to leave it at there. So let's give it up for the panelists. All right, our next panel is going to be on crowdsourcing, and it's going to be moderated by Natalia, and it's going to have two of my esteemed colleagues, Panos Ipeirios and John Horton, talk about the research.
No. Okay. All right. So we have another interesting panel that's sort of again switching the focus back to crowdsourcing a little bit rather than crowdfunding. I guess Anindya designed a really cool program so that if you're into one and not the other, you'll just have to wait one session. So so we have three very exciting talks coming up. One is by my colleague Panos Ipeirios. Panos is known as a computer scientist in a business school. That's his blog, if you're interested. He has a PhD in computer science from Columbia University. He does really cool projects around technology for crowdsourcing. And in this particular talk, he will talk about a new tool he has designed to source new information, new knowledge from potentially billions of users. I don't think others can easily say that. There are a billion participations. This would be followed by Lukas Biewald, who is a CEO and founder of CrowdFlower, which is a leading crowdsourcing platform for task-based crowdsourcing. So this is sort of a contrast with an earlier session we had, where lots of things were about crowdsourcing for innovation. This session is crowdsourcing for labor, for tasks. And this would be followed by a talk by John Horton, who is my newest colleague. John has a PhD from Harvard in public policy and was the chief economist at Odesk. So you could guess what his subject of his talk will be. He will be talking about online labor markets and the matching problem. So, Panos, you ready?
I'm not actually, but...
Okay, I can talk more. So, how is it? Nope. So even a computer scientist cannot solve technical problem in a business school. It's this business school that's the problem.
So I cannot. Okay.
Okay, good.
Okay, apparently my slides are not used, so... Okay, so what I'm going to describe today is the project that I ran at Google while on sabbatical there. So when I went there, they told me the following: well, we want you to do crowdsourcing. We know that you are doing crowdsourcing. We have 1 billion users that are visiting our platform. And what we want you is to get their knowledge so that we can better organize it and make it available to everyone. So just to give you a little bit of context on that, so you might have heard about Google and the knowledge graph. So the basic idea is that Google now, excuse me? Yeah. So that, yeah.
The fun just left. Now you can.
I do quality control on the crowd now. So when you are asking things on Google, Google now, they don't treat things as pieces of text. Instead, they have a whole set of entities. For example, if you are asking things about Kyrgyzstan, they know that Kyrgyzstan is a country. Therefore, it has attributes like capital, currency, and president, and so on, which in turn, they are also entities with their own properties and so on. So Google is using that. For example, if you ask what's the capital of South Africa, you're going to get back directly an answer. For example, South Africa has 3 capitals, Pretoria, Cape Town, and Bloemfontein. And this is especially useful if you are doing mobile devices, so you can ask your device what's the capital of South Africa, you get back the answer, what's the weather in New York, and so on. Here's the problem, though. The knowledge graph contains approximately Desk and so on. However, the problem is that in many of these platforms, you cannot go for targeted people that have specific knowledge. So, and also it's very difficult to make it successful crowdsourcing projects in a very predictable manner. So what they tell me is the following. So we want you to build a crowdsourcing system so that in a way that we can replicate it. So we don't rely on random successes like Wikipedia and so on. We want knowledgeable users to participate. We don't want just random people that we hire online and hope that they have the knowledge. And we don't want to pay them. If Google introduces monetary rewards, it opens Pandora's box on all sorts of perverse incentives. So what we did is we built a small game that we call Quiz. So in that game, people come and they are being asked questions like, for example, this is a medical quiz. What's the symptoms of Morgellons? And they get back a set of answers, and they say, for example, what's the symptom of Morgellons? One of them is correct, the others are not. And as they play this game, they assess their own knowledge, and they get, for example, that they are in the top 10% of users in the medical domain. So what's the trick? The trick is that we don't know the answers for all these questions. we actually know just a few of them, which we call calibration questions, and we estimate how well the user knows the topic. And the collection questions are things that the user, that we don't know, but the user knows. So when we collect information about the collection questions, we tend to trust more the answers that come from competent users. So it's a very recaps style game if you are familiar with recaps. So of course the question is, okay, Panos, so you were telling us how difficult it is to get people to participate in these things. Why anyone would come and play this game? Why knowledgeable users would come, and isn't it just simpler to pay? So what we are doing is we're trying to think how we can target people that have the knowledge. We're trying to think of new algorithms, new technical solutions, and we realize, well, Google has one of the best targeting mechanisms in the world, their advertising system. So we started running advertising campaigns that were really like that. You know, take a quiz on disease symptoms and test how well you can recognize various disease symptoms. And we placed these ads on various websites on the internet, and we're attracting people like that. So there was one trick. We didn't want to kick down the button and say, well, we want now to optimize the ad campaign. We wanted the ad campaign to run by itself without any intervention on our part. So for that, what we do is we treat our website as an e-commerce website, and every time that we get users from the advertising campaign, we tell back to the advertising system whether the user participated in the quiz and how much they participated. In the same way that an e-commerce system might say, we got users from the advertising campaign, did they buy anything? If they buy anything, how much did they buy? And of course, we ask the advertising system to optimize for high-value users. We want users that come, they participate a lot, they give us high-quality answers. So, and for that, we had some technical solutions to estimate the value of the users. But that's the key idea. When users come, we estimate through calibration questions how good they are, and we measure how many questions they answer. If they are good, we tell the advertising system, bring us more users like that. And we run actually experiments to see whether indeed we are better than, whether we are doing good targeting. And for that, we ran two parallel systems at the same time. One was we just brought users to our website without targeting. And the other one was we're targeting users using the advertising system. And we realized that targeting from AdWords is actually really, really good. So first of all, we had 3 times more participants that converted, 34% conversion rate versus 15%. The users were giving more answers when they were coming from the advertising campaign. On average, they were giving 10 times more answers. Plus, they were giving us much more high-quality answers. And actually, we realized that indeed the advertising system is working. So, there's a buzz. Okay. So, and that's an interesting case. So, we're thinking, what is the limit of what we can crowdsource? And for that, we ran an experiment where we said, well, you cannot crowdsource medical topics. If we get random people from the internet, they will not know how to answer these medical topics. Well, our hypothesis actually failed spectacularly. When people participating in medical questions, they were coming and they were participating tremendously. We had users coming and doing 200 questions in a row and 190 of them correctly. So we're looking at that and we said, who are these people? Who are these people that know these obscure topics? We're talking about questions. I was looking at them and I could get no clue what it's talking about. Neither what the question is about, neither what the answers are about. And we realized that most of the users were coming actually from prosumer websites like WebMD, Mayo Clinic, and so on. So you had these people that are interested in the topic, the hypochondriacs, let's call them. They like to assess their own knowledge to see how well they know the topic, and they like to participate in this game to see that they are ranking very, very well. And well, we had this, of course, power law distribution of users. We also tested what are the things that keep people around. For example, we realized that if we tell people whether they are correct or not, it increases a little bit the participation. But if we tell them what is the correct answer, it actually increases by 20% the participation, which means that users don't just assess how well they know a topic, they really like to know more about the topic. So whenever they answer something incorrectly, they want to know what's the correct answer. We also realized that we should not incentivize things that we don't want people to do. For example, we incentivized at some point number of correct answers, which led people to give us a lot of answers, but not necessarily correct one. They were just clicking randomly, hoping that they will get some answers correctly. They like to compete. If they were knowing what are the statistics for this question about other users, 10% increase. And the most interesting one was we said, okay, if people like to compete with each other, leaderboards are going to be great. Interestingly enough, leaderboards had a very strange effect. Initially, they were great. We were very happy. After a month, they had no effect. So we say, okay, we're lucky initially. Then we realized it started having a very strong negative effect in participation. So what happened was, because we're running all-time leaderboards, early on, people felt that they can get to the top numbers very, very easily. After a month, people in the top 10, they were so far ahead that people didn't really get influenced by that. After a while, at the very top, it was so far ahead, the scores of the top users, that people said it doesn't make any sense for me to try to compete in that one, and they were dropping out. So actually, it's an interesting example of leaderboards, and here is also a plot that shows how many answers were submitted by these users, and what's the average probability of being correct. And what we realized that self-selection in this game actually works very well. Since we don't pay users, people have no incentive to keep participating if they are not good. So in contrast to other environments. So early on, people are almost random. People that answer just one question, they are effectively random. They have 25% chance of giving a correct answer when they choose among 4 answers. Later on, people that answer 100, 200, 300 questions, most of them, they have very high degrees of success. They really play because they are good at it. The bad people drop out, and actually that's a very good side effect. And I will wrap up. So we tested this advertising-based approach for targeting and recruiting people to crowdsourcing applications, and we think that it works very well to attract targeted crowds. An extra benefit is that if someone is running a nonprofit, or they have citizen science applications and so on, Google is providing $10,000 per month in advertising budget to nonprofits in order to use for whatever purpose they want. So people that are running citizen science projects, they can really leverage these things and target specific crowds for their application. An interesting case that we ran was a climate collab from MIT, where this project, they are trying to attract people to submit proposals for climate change mitigation. Very different beast. We started targeting initially people that are interested in climate change, and was working decently. But after 2 weeks, we started giving feedback to the advertising system, how many users participated in the process, how many people voted in proposals, how many people created proposals, and so on. The advertising system came back and says, you're targeting climate change for this thing, and that's not a good audience. Instead, you should target these websites, and they start giving websites about, feminist websites, civil liberties websites. Effectively, what AdWords realized is that people that are just interested in climate change, they are not the ones that are going to submit proposals about climate change mitigation. These are the people that are learning about the topic. However, activists, people that have a social, they want to act, people that are participating in civil liberties activities and so on, these are the ones that are most likely to act. Therefore, these are the audiences that you should target for that particular application. And this thing happened completely automatically and without any of our intervention. So it is very good for discovering new audiences for the applications as well. So, and we're running some other experiments as well, and we'll see how it goes. That's it. Thank you very much.
Hi, so I'm Lukas Biewald. I'm the CEO and founder of CrowdFlower, and it's exciting to be here, actually. I remember when I started the company, Panos is also starting his blog at the same time, and I've been a huge fan of his blog, and I've read it for years. And it's funnily named Behind Enemy Lines, I think is an interesting name for a blog of a professor. You should all check out his blog. And so I run a company, CrowdFlower, and we're kind of a classic Silicon Valley startup at a growth stage with about 100 people, mostly based in San Francisco. And what we do is we manage an online crowdsourced workforce of over 5 million people that log in and do tasks for our customers. And I always like to say when I give a talk, if you're on your laptop and I'm boring you at all, I would be so much happier if you became the 5 millionth first worker, and you can actually make some money and probably get a better idea of what CrowdFlower does than listening to me. So feel free to go to crowdflower.com and log in and do some tasks. And so, what I love about CrowdFlower and what I love about the kind of online work industry in general is I think there's an amazing chance to unlock the potential of the billions of people that are moving online. And I really, really want to help companies do things that they would never do before and give everyone in the world with access to the internet access to work, because more and more people are getting that access. I think there's a broader trend of companies moving from giving most of their work to employees to sending more work to contractors, to sending more and more stuff outside the boundaries of their company. Accenture, I was just talking to their CTO who's talking about kind of the boundless, boundaryless enterprise, which I think is a great term for a big trend that's happening for all companies. And I think that I think this kind of crowdsourcing is a huge part of this phenomenon, where you actually don't need 2.5 billion people to do your tasks, but if you can find the perfect person to do your task, well, that's an amazing thing, right? The optimal person for any particular thing that you want to accomplish is probably not someone that works for you, just probabilistically speaking, right? You only have a few hundred people or a few thousand people in your company, and there's billions of people available. And the key things that you need to solve is you need to find that person, you need to explain to that person what you want them to do, and you need to make sure they actually do a good job. And so that's what CrowdFlower does for our segment of the industry. We have maybe less customers than other crowdsourcing companies, but our customers tend to be very big and very engaged and send lots of work through our system. And our typical customer is doing something that we've started to call data refinement. So this is a phenomenon that I think every company has, where you get more and more data, and it turns out you have some kind of mess, and you need to clean up that data. And this could be as varied as we work with satellite companies that get pixels from their satellites, and they want to sell to their customers insights, right? So they might want to say, we want to track the number of containers on a ship, and so someone has to actually look at those pixels and decide how many containers are on a ship. It's actually a harder vision problem than you'd expect. Another common thing is companies with huge customer databases have a really hard time cleaning them up. So a really concrete example, and one of the companies that we can talk about is Autodesk, has over 1 million customers, which I think is amazing. And they're all around the world, and they will decide to do things like, okay, we want to have a new kind of categorization system so we can really effectively compensate our sales force based on what we're trying to accomplish. So they don't want to use just the government codes or the codes they can buy from a information provider. They want to have their own unique taxonomy. And so what they do with us, and I think this is maybe a little different than how like Odesk or Mechanical Turk would look at it, we don't give them direct access to our workforce. They go through our platform. And what our platform does is it takes each individual record that they want updated or augmented in some way, and it parcels it out, right? So all 1 million customers would create an individual record, and Japanese companies would go to people in Japan or people that we have reason to believe can speak Japanese. French companies would go to people in France or people that we think can speak French. And then it might even go to multiple people, right? So if someone answers the question and we're not sure, if you just log in today and you start categorizing some of these businesses, we'll probably have a second person or a third person check that data to make sure that's really good, right? And what happens is you can actually take complete control over the cost-quality trade-off for yourself, right? So you can decide, I can pay more for really high-quality results, or I can pay less for less mission-critical results. And so what's amazing about this is once you set it up, you can do it in real time. So as customers ask for white papers or sign into your platform, you can actually populate jobs. And lots of our customers do this, where they'll immediately populate a job, and that business will get categorized. We'll add metadata like maybe their Twitter account or their Facebook account. And in real time, it'll get sent back into their CRM with that updated information. The whole process can take 10 to 20 minutes. I really love to show examples of what our platform really looks like to make this really tangible. So this is a real job I'm running for one of our customers. And the x-axis here is hours, right? So you can see they've set up a job. They've paid $5,600, and they have a continuous flow of people coming in and doing those tasks. And they can get insights into how many people are passing. In this case, they've set up a quiz that people need to answer before they get into the system, and so they can see the funnel of people getting the quiz correct or getting it incorrect. And they can see there's a continuous flow of people getting graded, and they can see how many people are kind of passing that or getting rejected. And they can also actually see the contributors working on their tasks, how they feel about the task, right? So they actually take exit surveys when they leave the task, and so they can get direct feedback on how well the job is working. This is an example of something a worker would see, that you would see if you're logged in. This is someone rating the results of a local search engine, saying, are these good results or not? So you can see down here is the interface where they answer it, and up here is some data that lets them, that gives them context to answer a question. And so our customers actually literally will use our tool to set up these types of tasks. This is another example of categorizing products, I believe. And one of the really important things that we've learned, just to give one example of how we manage quality, and actually relates to what Panos was talking about, is test questions. So we found that a really good way to allow yourself a really wide funnel of workers is to set up questions where you know what the answer is, and just make sure that they're answering those questions the way you want them to, right? Then you can give almost everybody access to your test questions and let through the people that answer them correctly. This is actually harder than it looks. So we found when customers set up 100 test questions, on average, they'll mislabel a few of them, and a few of them will have ambiguous instructions where actually a smart person, motivated person couldn't get them correct. And then a few of them will actually be really good examples of tricky edge cases, right? So there might be, I've often learned with addresses, depending on what you're trying to do, different addresses make sense, right? So you might want the mailing address, you might want the physical address, and each customer has a different notion of what they want. So setting up test questions that kind of test these edge cases are great, but then you also need to take out questions where workers are complaining or contesting them and iterate on your job to get really high quality results. We also give people access to lots of different validators and tools that make sure that the results are good. So that's sort of, these are two of many different tools that our customers use to make sure they get good quality results. I view what we're doing is automating not just the process of finding someone, but automating the process of managing them well, right? Setting good expectations and making sure that people are meeting those expectations. And so that is really what our software platform does for our customers. But the more fun thing is to tell you about the things people do with this, right? So I think one really cool example, this is a startup, but they've actually been growing a lot. We can see that from the volume of stuff they send us, is Delectable. So anybody heard of Delectable? Anybody use it? No? Delectable. Yeah, so it's actually an iPhone app where you can take a picture of a bottle of wine, and they recommend other wines. And so this actually, when you take a picture, they tried to use OCR, but wines are, I mean, OCR is pretty good, but wine's actually particularly tricky for machine vision to transcribe because they'll use these funny fonts and they have kind of funny words in the names. So when you take a picture of your wine, it actually populates a little task that gets done by someone maybe halfway around the world, and then you get back the name of the wine, and they can actually recommend other good wines. And this has been a real driver of user happiness for them, and delivers a really magical experience for their customers. Another great example is, there's lots and lots of apps in the iPhone App Store, and one thing you might not know is Apple actually requires everyone that accepts user-generated content to moderate that content, right? Which is really, it's easy for a big company, but tricky for a little company, right? So if you have users uploading 5 images a day, no outsourcing company will touch that, right? No, you can't staff for that, right? And then, one day, you get your crowdfunding campaign starts working, and you get tons and tons of users, right? And then you need to have a system ready to deal with that. So we integrated with Parse, and with just this amount of code, you can actually set up a system where human beings really check every photo that your users upload and make sure that the content's good. And so this has been a really popular thing with indie developers to give them access to the same tools that a Google might have to keep them in the App Store and keep Apple from complaining without a huge overhead fixed cost. Another cool example is retail geofencing. I just think this is really neat, right? Where they take satellite photos and pick out exactly where the stores are, so that this company can give people information when they walk inside the store and actually send that to their cell phone. And here's a case where we aggregate. Each thing has a different notion of aggregation. So when multiple people put in GPS locations, you aggregate that differently than if somebody's categorizing businesses. You don't just probably pick the most common, because no one will actually say the center of this business is the same. So in this case, you kind of average them in an interesting way. Another really meaningful example of this was actually after the earthquake in Haiti a few years ago. So we had just started to build the system, and there were a really smart nonprofit set up a text messaging service on the ground where people could text. Hey, I'm trapped under a building, or hey, like someone near me is going into labor. But the people were texting in Creole. And so they actually went to Google and said, hey, do you have a translator? And Google said, this is actually a really difficult problem, because not only is Creole kind of a funny language that we don't have a lot of data on, but the text message Creole is even harder, right? So they said, wow, we need a whole ton of translators to deal with all these text messages, right? So you have the same issues with, you want it to happen in real time, and you want the translations to be really good, so you don't necessarily want to open it up for the whole world to come in. And so they ended up using our platform to do these translations here and actually locate exactly where on the map the disaster is happening, which is a great example of how powerful the service is, right? Because you could never staff enough people to always be ready to do Creole translations when there's a disaster, but right when it happens, this kind of platform lets you scale up really fast. And when I talk to business people, I say, you might have the same issue if you have a B2C application, where you never know when suddenly there's going to be tons and tons of people coming into your to your application. Another really exciting example that's been taking off for us is actually medical research. So we see a lot of vision-related issues in medicine, where people want to label the cells on a slide or neurons or things like that. And it turns out that often these tasks are actually better done by our workforce, which is super careful, than by graduate students who can be less careful. And I think another really cool example, so this is just a great example from the NIH that was actually taking drug descriptions and asking, what does this actually mean? Which is an example where you might not necessarily want the most sophisticated person doing the task. You might want to ask, hey, can someone actually understand what these drug warnings actually mean? We can also do some amount of targeting. In fact, we have a customer that's doing diagnoses, which I'm not sure if that's a perfect application of our system right now, but with test questions, you can actually measure if it's working or not. But this is a great use of when you'd actually want lots of people to weigh in on something you're trying to accomplish. And then this is the Autodesk example. Again, this is kind of the typical commercial example that we give. And so, people always ask me kind of who are these people that do this work? Who is this crowd? And it's amazing the diversity of the crowd. We work with, it's completely global. We have people in every country, and we have actually over 1 million people in the United States doing it of kind of all ages and backgrounds. And so, I would recommend that you should sign up for the crowd and become one of our workers. Thanks.
Okay.
It will probably come out again. Hello, my name is John Horton. I'm a professor here at NYU Stern, but as was mentioned earlier before, I was a staff economist at Odesk, and this talk is kind of more motivated by my industrial experience as opposed to my academic experience, but they're connected. So imagine you needed to meet a friend in New York City, let's say at noon on January 1st, 2015. But you can't talk to them ahead of time. Can't converse with them. They don't have a phone. You can't email them. You just have to pick some point in the 5 boroughs and hopefully meet up with them. Where would you go? No one say anything. Just think about it for a minute. Think about it for a minute. I'd be willing to bet that a lot of you thought of this. Okay, the information desk at Grand Central Terminal. It has a lot of properties that suggest that would be a good place to go if we couldn't talk. Okay, if you're not from New York, you may have thought about this. Non-New Yorkers sometimes suggest this. This is actually not a good idea. Okay, so this isn't my example. This is an example from Tom Schelling, who won the Nobel Prize in 2005 in economics. And, but he was the first one to point out this importance of focal points. These are things that, there's nothing inherently that says, Grand Central Terminal, no one announced this is the place you go for this kind of thing. But it becomes a convention. It helps people coordinate. I would argue that crowdsourcing and crowdfunding depend on a kind of coordination that's like this. And let me just back up a minute and say, in any kind of market, before buyers can even begin to haggle, come to terms, they need to find each other first. They need to find each other in time and space. And if we look around us, there are many solutions to this problem of trying to bring people together. So you have city districts. You can go to, used to be Fulton Street, but now Fulton Market in the Bronx if you want to trade fish. If you want garments, if you want diamonds, you go to certain places in the city, and that's where you go to trade that thing. You can see it with market days, where a market's going to happen on this day between these hours at this location. And what it is we're setting up a convention to try to thicken up the market so there's sufficient numbers of buyers and sellers at that location. And if you start looking around, you start seeing these sort of guideposts all over the place that tell people this is where you go to trade this. All right, so what's the crowds connection? Well, I would say that crowdsourcing, crowdfunding, there is this substantial search component. Oftentimes you have both workers and tasks are idiosyncratic, investors and projects are idiosyncratic, and you're looking to engage in this sort of one-off, one-shot transaction. It's not like you're a restaurant and you go to the Fulton Fish Market every single night and buy fish. It's sort of a one-off thing, right? You're going to go work on one of Lukas's tasks that maybe you'll never work on that kind of task again. And so in that setting, it's hard for conventions to arise about where you go to trade a certain thing. It's a difficult problem. And I would say that in the crowdsourcing context, it's both a blessing and a curse in that the problem is really hard because you have a market that's not at all constrained by geography, right? So this is a picture of Adam Smith's famous pin factory, where he was the one who said, if you can take, rather than having individuals make pins, one pin at a time, you can break it up and some person can specialize in cutting the wire, another person can specialize in putting on the pin heads, and this is great. You can get a lot of efficiency gains from this. But he also pointed out that the extent that you can do this is going to be limited to how many pins you can sell. It doesn't make sense to specialize lots of people doing the little tasks of making pins if you can only sell a dozen of them. So what's the crowdfunding connection or crowdsourcing connection? Well, we're in a world where you can have people do tasks for which the global demand is only 40 hours a week. In our best imagination, it can be something where you have really, really hyper specialization. People can really, really focus on something. The flip side of that is it's going to be that much harder for people to find each other. If I need to find someone who they're the only person in the world who does that thing, it's going to be a challenging task to me. And so what do we do online when we have to do this coordination problem? Well, we don't get geography, right? So we can't use streets, we can't use locations. We can't really use time either. You know, these markets are asynchronous. They're usually running all the time. It's not like we can say these are the market hours. So what do? Well, we do things like how we have recommender systems. So we try to use algorithmic means to match up buyers and sellers. And we can try to put things into categories. So we can try to create a taxonomy of goods in a marketplace, and hopefully people will self-classify and put what they're selling in the right bucket. I think that a lot of Odesk faced this problem in spades of trying to put things in the right bucket and help people match. So Odesk is an online labor market. People can do computer programming, graphic design, data entry, but it's usually much more finely scaled than that. And I think some of the things that worked well on Odesk and sort of apply to all platforms. One is you want to find the facets that are important in your market, right? So what are the dimensions of buyers, sellers, and goods that people care about? And then try to build tools around them. And one thing that worked really well was most sites, electronic commerce sites, have some kind of a search feature. Just looking through the query logs, you can get a sense of what people take and use to try to find each other. What are the words that they use to describe certain things? And that can kind of be a jumping off point. Another thing you can do is try to force or nudge people towards using a controlled vocabulary. Meaning, if you can just get everyone to use the same language for the same thing, that's often a first step towards helping people find each other. If they have different terms or two sides have different terms, it's going to be a lot harder to create that thick market that you want. And the last one that's a little bit cut off is that you can force explicit trade-offs where people have to pick from some controlled list. I have to pick A, B, or C, and then that can get broadcast to the market, and that's another dimension people can use to help find. One of the things I did at Odesk was to start organizing the skills. So a lot of the supply and demand is organized around the skills that people have, technical skills. And before, everyone could just enter in their own skills when they were describing their job, and they could enter in their own skills when they were describing their profile. And I saw basically every single way a person could write PowerPoint, I think. This is like a small sample of the ways, and this just was repeated for every single skill. And so you can imagine the difficulty of getting people who needed PowerPoint, if they didn't enter it in exactly the right word, depending on how sophisticated your search engine is, you're going to miss things. And you can keep making your search engine more sophisticated, or you can try to get everyone to use the same terms for the same thing. Another example, this is, even if you can get things down to a finely grained, this is computer programming using the Python programming language, people have differences of, I really want high quality at a high price. I want low quality to low price. They're still differentiated on that other dimension. And this is an example of forcing people into explicit trade-offs. So when people post a job on Odesk now, they have to say if they're looking for entry level, intermediate, or expert. And they have to pick that, and then that's revealed to the market. And what you find is that you get a lot of sorting. So you can see, because it's an online marketplace, you can see people's historical profile rate, their historical earnings, and you get a nice separation where people apply to the right job for them without just bidding up that, not bidding up too much. There's a little bit. That's not necessarily bad for Odesk either. Now, this kind of applies, I think, to almost any kind of market where people are selling things. When you have crowdsourcing in particular, people care a lot more about the identity of the person they're paired with to trade, right? We're not talking about people, buying something that's a commodity and you really don't care who the seller is, or labor in particular, you really care about the worker that you get paired with, and the worker cares about the firm that they get paired with. So you have this matching market where people have to both choose and be chosen, and this introduces a lot of complexity to this matching problem. And just to give you an example, so let's just consider the Netflix problem. The Netflix problem is you have viewers and you want to recommend movies to them. So here's Stephen Colbert. Do we recommend The Godfather or do we recommend Frozen? Okay. So this is a problem we've kind of thought a lot about. Netflix challenge, research on recommender systems. You collect people's preferences. You can do a lot with this. Well, how does it become more complicated in a matching market? Well, one, the movie might say, I don't want to be watched by this guy. That's the same as a worker saying, I don't want to work for this person. Okay? So if Netflix had to take that into consideration with every recommendation they made, the movie they recommend might say, no thanks, not interested. That's a complication. You could also have stock out. They do actually have a version of this where I'm already being watched by someone else when they had physical discs, but now at least when things are streaming, you have less of this. But this then becomes a very important matching markets where it's a labor market where a person is inherently restrained in how much supply they have. This kind of problem will come up all the time. And if you look at other marketplaces, this is a big problem on Odesk. It's a problem on Airbnb. Managing availability. You can't just continue to direct all your traffic at your best seller. You have to apportion it out among your sellers in some way. And this is just another complication. You can have incomplete information. So Netflix knows that that's The Godfather, but in reality, in a labor market, you'd say I'm a movie about the mafia. Could be good, could be bad. There's a lot of movies that meet that characteristic or characterization. And so making good recommendations when you only have this kind of incomplete information is quite challenging. But that's not terrible. What's really bad is this one. Deceptive information. So you can say, no, I'm not The Godfather. I'm the Lord of the Rings, or I'm whatever you want to be. Just hire me. And this also happens in matching markets to a big degree. So you can kind of keep track of the time. I have 5 minutes left. You're probably not expecting me to have 5 more slides that say this is how you solve all these problems. I'm here more to just point out they are problems, and they're tough problems to solve, but they seem to be something that's common to all of these kind of matching markets. Crowdsourcing is no exception, and it's something I spend a lot of time thinking about. Sort of what are sort of steps, or what are tools we can use to solve these kind of problems. So solution, it's a work in progress. I do not have a solution. And so that's my last slide. And I think now we'll move to the Q&A.
Yeah, you can.
I think we had a fascinating session with really very interesting talks and a common theme. Maya? Okay. So I have a few questions, and I was trying to see how we're doing in time. But actually, I would try to phrase it as one question to everybody, which is, what sort of is the boundary condition for when this kinds of crowdsourcing platforms sort of stop working? Or what are the kind of problems that you think your exemplar mechanisms are unlikely to be used for and most likely to be used for?
Should I start?
Yeah.
So we have a really specific point of view. I think crowdsourcing can do a lot of things that CrowdFlower doesn't do. But we really like to work on tasks where there's a clear notion of quality. So for example, we don't do logo design because it's not clear what it means to make a really great logo. And we don't do kind of ideation, like I think a lot of people in crowdsourcing do, where you want like lots of opinions. We like contain tasks with a clear notion of right or wrong.
And by clear, you mean accepted by everybody, both solution providers and solution seekers? Yeah,
where you can define it. So it's okay if there's some ambiguity in like the first set of instructions, but then we try to work with, we try to make mechanisms where the people doing the work and the people requesting the work actually talk to each other and clarify what they mean by a correct answer.
Great.
Yeah, to give an example actually that happened today. So we're asking people what's the name of Neil Armstrong's spouse. And the answers were actually generated automatically. So one of them was Gemini spaceship, the other was Laika, and the third option was none of the above, or I don't know. So people look at that and they say, definitely it's not Gemini spaceship, definitely it's not Apollo. So this Leica thing seems like a woman's name. It's related to space. I have heard something. So we had 37 people selecting Leica out of 2 that selected none of the above. What happens is that there are some, and no statistical technique can fix that. You know, we tried everything, so there are biases that people have. They feel that something is obviously a correct answer. So when you have such cases where the crowd or people in general obviously believe something to be correct, while it is not, and the truth is in the minority, then these are the cases where you can fail and fail very spectacularly.
Interesting one.
So we're about to put on Google that if you type Neil Armstrong wife, you will get Leica.
You should use CrowdFlower.
Can you talk her into a name change? Yeah, I mean, so I think I sometimes think of Odesk as people are trying to find employment-like relationships. So it's not a clear sort of boundary of the firm question, which you might kind of think of crowdsourcing as. But I do think that the sort of people do weigh the costs and benefits of outsourcing something or finding a freelancer, and it usually comes down to like how much time is it going to take me to describe this task? How much of this kind of work do I have? Does it make sense to create this relationship? So I think people are kind of viewing it as a weighing the costs and benefits of.
It's the investment
decision.
required.
Yeah.
Let's open it up. Thanks for great answers. The gentleman in the back.
Can you kind of talk about the level of complexity that the tasks that can be crowdsourced can go for? I'll give an example. Like picking the name for something is a very short and simple task, even though it requires probably a human brain, right? But going through a long list of things to accomplish a goal might be more complicated. Where is the good point at which you want to limit the complexity and length of the tasks?
I could take that. So the way I look at it is I don't think there's like a practical. There's not a intrinsic limit on the complexity that you can have as long as you have a clear notion of is this correct or not correct. But there is kind of a practical limit. Like I think that if you are putting stuff in our system, and I know this really well, right? So customers ask all the time, can I do this? Can I do this? Can I do this? I think what you should think about is the amount of task-specific training that you're going to need to do for that person is now going to have to happen for every person that comes into the system. So, if you have one task and the training takes, if you have 10 tasks and the training takes tons of time, you might as well just get one person and have that person do all 10 of the tasks, right? And so I think that's better done on a platform like Odesk, where you find like one person and have that relationship with them. But if you have thousands of tasks and the task-specific training is short, then it makes a lot of sense to use our system. So if it's like a set of skills that someone might just have, like being able to read Japanese equivalent of SEC filings, right? You can actually find those people, and maybe you don't need to do a lot of task-specific training. But if you have something that's really unique to you, I think the more complicated and unique something is to you, the more incentive you have to kind of draw that person into your company, right? Like if you're always going to have to do this complicated thing over and over, you probably want to get a real employee to do that every day.
Hi, my question is, how do you see this affecting traditional labor, and is it driving firms away from hiring people to just crowdsource a lot of their work?
Okay. I think it's quite the opposite, actually. Once people realize that they can automate, systematize, and manage large amounts of people through a crowdsourcing process, they can hire thousands of people. And they don't feel, worried about how to manage this crowd. There are many, many companies that have internal, let's call them crowdsourcing projects. Effectively, they get a lot of people that are doing clerical work, but they are supervised by machines. They are not supervised by other people anymore. And this scales up very quickly.
Yeah, I mean, I think that the question comes down to is, how much of the work that's done like this is work that wouldn't have been done anyway, and so this is like new work that would have happened. And then I think the other question is, and it's probably a little bit more Odesk specific. If you are a software developer in Silicon Valley, and now you can take and potentially outsource some of the things that, writing boilerplate code or filling out expense reports or something like that, you can become more productive, which, should in principle increase the demand for your labor, not decrease it. And so, I think it's very easy to think of things in sort of a substitutes framing, but, I think this is a kind of labor that could actually be very complementary to kind of onshore work. But, I would also admit that I think there's a lot of uncertainty about this, and, these are kind of hard questions to answer.
So, John, you open with this analogy of like you're meeting with a friend and you don't know where and you can't talk, so you choose Grand Central. But so, to what extent do you see, I guess any of you see, communication between the two sides of the marketplace outside of the platform, and then they find each other on the platform? Like on Odesk, are there talks before they get onto Odesk?
I mean, very, very, very rare. I think that there are some. I think they built some features about sort of like bring your freelancer to the platform, but I mean, the reality is that most of these relationships are north-south. Sort of buyers in the U.S. and Europe, and hiring workers that are much more global. And so it's not like I have a friend in Bangladesh and I can say who's a good person for me to hire. Like, it's more likely that the match is going to start through Odesk. If anything, it's probably more common that we make the match on Odesk and then go off to avoid the percentage fee.
I would just add that I think one of the biggest surprises I've had running CrowdFlower is the number of companies that actually use it as a system to organize their own workforce. So this is where you actually have that employee relationship already, and then they use it to kind of organize everyone's responses to something.
Well, perfectly on time. Thank you very much. So, I think we have a break. Next. There is a break.
There's a break right now for just maybe 10 or 15 minutes, and then we'll come back with the last module.
We missed the best ones. Yeah. I suddenly realized where it was so glad where we had a coffee. I really like the It's definitely much more business angle than I'm used to thinking about this, and it's really, I'm learning enormously. Like, I normally hear other people doing stuff that we're doing. So it's great for me to see the depth of thought on business.
So I'm the next speaker. Should we get? Let's get it rather. Sure.
Basically, I asked him so I understand for information I think they're very ambitious to try all three. The things we're just providing the cross ideations.
That's why I'm on. Right.
How much now enough to build essentially
Thank you, sir. Thank you. Three. Let me check. You were on 3. So Noah's on 3.
So in terms of the presentation, is it on this or do I put my laptop? Like on the
I don't know exactly the answer to that. Mandie in the red hair would be the better answer. So 5.
All right.
Do you want me to send you a PDF? Is that better?
Do you know I have them right here?
Okay, cool.
Here, make sure that they're. Yeah, and here's the clicker. So if you want to just.
Stop making slides that make us academics look bad.
I know they're beautiful slides actually.
Oh, actually, no. Can I send you? Let me send you a PDF version. Can I email it to you?
Yeah.
Yeah, because the font's not right.
Oh, okay, sure.
Mine really quick too.
Sure, of course. Here, I'm gonna escape out. Sorry.
So what email should I send?
Can you send it to M Osborne? I think it's the email that you have for me, but I can also just read it for you.
Hold on.
Ethan, here you are.
All right.
You want to just go through, and then I'll start the slides for both of you if you'd like to make them go
So
faster.
you said M Osborne?
Yep, it's MOSBORNE.
Great, I'm good.
Good. Right on. At Stern.
Not remembering what you did.
Dot NYU.
You came up with
NYU.
Dot edu.
Thank you very much.
All right, let's see.
All right, here, let's do it.
Yeah.
I'm gonna delete this other one then.
Yes, please.
And get it out of here.
Can you tell us?
Yeah, I figured because that font is specific and good installed and changes.
I hear you.
Like one of our good friends with his roommate.
All right.
Lovely.
Awesome.
Yeah, it was at the Redwood City Farmers Market. We've got kids our age. They should be fast. You have learned that some. Yeah.
No, where it's saving. I'm not sure where it's going.
I think you saw it. A few
more people
I did see it.
He's going to use the bathroom real fast.
Of course, please. This is so strange. I'm not sure where it went. It should be. I'll just look in here.
Maybe you want to search just in the search thing.
Yeah. I haven't used this before. Is your name?
No, it just says NYU presentation, which is not
Okay.
very helpful.
That's okay.
There we
That's
go,
why.
it's
Do you know what it is? That's why. Because I was looking for something that had your name, which makes no sense. Which makes no sense.
Okay.
All right. Do you want to click through and just see? So we've got Gord, needs to be Mike.
Yes.
Thank you very patiently,
So we were searching for someone walked off with one. And
Oh no, Alejandro. So I'm sorry, so Giannis, Sonohe, Gord.
Deborah?
She hasn't arrived. So we may
I'm
end
good.
early. Are you good?
Yeah, I'm good.
All right, perfect.
Okay.
Great.
So, Sinoki and Deborah, are they here or?
So Snowy's here. Oh, I'm sorry, you haven't met.
You'll be moderating. Okay, great. So I'll invite you to do the keynote. What's actually going on? And then like a question.
Good.
So where we at?
We're here. So we're at the break, and we're here. And this person might be a no-show, which is fine because everyone's tired.
Okay. Yeah, good job kicking those people out. I was like,
Wait, what?
The people that were talking. Like, I was like, what's going on?
Here, I'm like, networking, network point. And, oh my god, I'm in so much trouble. So like, he like just brought his laptop and expected to be able to use. Did you see that?
No.
So he expected to use the laptop, and I'm like, no, you can't do it.
I'm totally sorry, but is there one
Of course, please. All of these, yes, please.
So, one of the founder of the package side,
I know.
Oh, you're not seeing it. You're not seeing it. But if it's something you...
Because not shown up, so it's possible she's not going to speak. So Ethan, it's fine. It won't be. So just know if there might be one less.
Did you know?
Oh, that's fine.
Which is fine.
They'll just be earlier.
Exactly.
So, all right, great.
Were you let the academics talk longer?
Yeah.
I know Albert and Fred very well. Okay. Yeah. Yeah. I know Fred not as well, but Albert and I were together in at MIT, so he was.
Oh, interesting. Interesting. Yeah. Yeah, he was always the art guy. We always thought of him as the art guy. That's yeah, because he was always really focused on the art category. So every board meeting, he wasn't a board member; he was a board observer.
Right.
But he was a very good board observer.
Actually, it's a very heavy
because he was always actually really engaged.
Right.
And he.
Okay, wait. So
and then took it to Fred. And this was
Gordon, and he found
only made on that one does.
Yeah. Oh, he has. He's a good guy.
On the schedule, sorry. So this person is MI.
Oh, okay.
Yes.
So Deborah. So we're gonna first to know who's first, and then Ethan.
Right.
And then Deborah. So Deborah is MI. Like I emailed her. I haven't seen her. So if she's not here, fine. It's a long day. It's a long program. So we'll just skip her. But I just wanted to sort of let you know it's possible that she might like just pop up.
Right.
But basically, what that might happen is we might go.
So,
I want to tell
I'll
Gordon
tell you
because
what
I want him to be ready.
What I will, tell Gordon to be ready. So what I do is I'll introduce him now, he'll invite him, and then I will do it one at a time. So I will.
I think that's perfect, just in case. Yeah.
And then if Deborah is here, I'll introduce Gordon next, and then by the time Gordon is done, she's still not here.
Right, exactly. And for some reason, she's like, you introduced Gordon, and she's here, and she's like, oh, am I not speaking?
Ethan's done already. Where's Ethan?
Exactly.
How about Peter here?
Yeah.
Right.
Right.
Excellent. And as I've been doing also,
Right. Absolutely. Yeah. Oh, so technically we need to rearrange the slides.
no, because they're not in, they're all separate. They're all separate files, just for these moments.
Okay.
They're all separate. So Gordon, can I tell you? I just want to tell you, so Deborah Jackson hasn't arrived yet, so it's possible that, so be prepared that you might go on after Ethan.
Okay.
And that's fine, because it's been a long day, and I just feel like if we end a little bit early, that's not a problem. We've had some great talks, and I think it'll be fine. I just wanted to let you know. Yeah, so I wanted to let you know that.
Oh, okay, that's good. I left you.
Go down the back of the shirt.
Whatever Jesus for you.
Thanks, sir.
Sorry.
You good?
Yeah, I'm the crowdfunding guy at work. I mean, we have a lot of entrepreneurs who should go over.
I'm just kidding. It's so tight.
All right.
That's okay.
Sorry.
Way, so.
Okay. Yeah, come to Billy or after something. Moderately after.
have Yanis over. Yanis is one of my colleagues at NYU Stern. He is considered as one of the world's, perhaps the world's most foremost expert on search costs in online markets. And he's done a ton of work in that space. So I'll leave it to there.
Thank you, Anindo. So we're reaching the final stretch with the keynote, followed by a panel on funding strategies. So the crowdfunding keynote, we're lucky to have Sinoji Terrero here. Sinoji is Vice President of Finance and Accounting at Indiegogo. Before that, he was at Etsy, also Vice President of Finance and Analytics, I believe, there. He's a little bit of a professor because he has taught financial statement analysis to MBAs at Baruch. And he is a certified public accountant and also, I have to read this, a chartered global management accountant, which I think it means that you personally review and audit every financial statement submitted
in the world.
In the world, exactly. So you're responsible for that.
Well, thanks for the kind introduction, and thanks for sticking it out. It's 4 o'clock, so I know it's a long day. I'm from Indiegogo, as I was just mentioned, and for us and our company, it's actually pretty remarkable to be in a full-day session where people are talking about crowdfunding, because 2 years ago, crowdfunding wasn't even a thing. And when I think about kind of like the founders of Indiegogo and kind of like the struggles that they had putting the company together and putting the idea together, it's been a long time. So I want to talk a little bit about the evolving marketplace and funding the big idea, and how we at Indiegogo think of crowdfunding as taking part in that, both from the entrepreneur side, but also actually from the venture capitalist side. So as I was mentioning, the founders of Indiegogo basically were 3 friends that got together and had a shared frustration with the access to capital, particularly the inefficiency in that access to capital and the basic unfairness. Danae, who's in the middle, she actually was a banker that her job was helping films get financing, and in doing that job, what she realized was that the system was actually not working for those same filmmakers. It just was not very fair the way that it was distributed. And the first thing that they encountered when they started Indiegogo is, the first lesson, a first-hand lesson at actually that inefficiency. They were turned down by 92 VCs before they ever got any funding. And I'm talking seed, I'm saying before they got anything. So they bootstrapped the company for a very, very long time before any one of us in this room even knew what crowdfunding was. So that was basically the first lesson for them. But fast forward to 2014, and the company that they built, has a lot of impact globally. Indiegogo disperses and distributes millions of dollars a week to different kind of campaign owners, some that are entrepreneurs that are doing actual goods, other people that are doing cause-related things, artists, films, you name it. It's a pretty broad group of categories, and it is an open marketplace, right? At Indiegogo, we don't think of ourselves as actually being the judges of the idea. We let the crowd judge the idea, right? Because the crowd is really going to know better than we, like if some of these things are really going to come to fruition. And when you think about it, at the core, like a lot of ideas, when they are first introduced, sometimes don't make any sense, right? People are like, that cannot ever happen. Electricity, what are you talking about, right? And it takes like a leap of faith sometimes to bring those things to life, right? To bring those things to fruition. So for us, we very much care about checking the individuals, to make sure that there's no fraud and stuff like that, but not about the ideas. We are an open marketplace, and we respect other marketplaces like our friends in Brooklyn, but we just have a different philosophy as to what we think is going to be, the most empowering marketplace. We really believe that it's an open marketplace. And the thing that we first found, so now we've got crowdfunding, that it's becoming a thing. The power of crowdfunding for us and the way we think about it is really in something that we call a feedback loop. Because at the end of the day, it's funding, right? There's a transaction of money. And in simple terms, it's, point A person has an idea, right? And point B person has the money. And it's very linear the way that we think about it, because most of the times when you get VC funding or even sometimes angel funding, all you are really getting is money and a promise to return that money, with exponential gains. But there's not a whole lot more that you get besides that money. It's kind of like in the 1920s, right? You went to a bank, you got in line, and there was this one person that decided whether or not your idea was worthy, like in the abstract, right? You had to go in with your business plan or with whatever you had as your assets to be able to collateralize, and that's the only way you got that funding, right? So it was either a line or you could have considered it a race. That gift looked much better when the presentation was put together. But under all circumstances, like basically there was a gatekeeper, right? There was this gatekeeper that was telling you, your idea has validation or it doesn't, right? Very, very abstract, and the power was really one-sided because that person really decided what was going to happen to you. So now enter crowdfunding and the obligatory happy GIF image, right? At Indiegogo, like I said, it's an open platform, and what it does is it changes that paradigm from that linear interaction that was forever the interaction that you had in funding to something that we like to call a feedback loop, right? Where your idea, yeah, you do get money, but you get a lot more than just money, right? The idea is the beginning, the money is part of it, but with the money, the really, really powerful thing as an entrepreneur is the fact that you get market validation, which is critical, right? The market is validating your idea, your product, your film, your, whatever, your album. Someone is actually, before it ever becomes anything, they're putting their faith in that product, right? You also get to test your own marketing. Most campaigns are about 45 days, and in those 45 days, there are tons of iterations that the campaign owners make to the campaign to make it more successful. Everything from the copy, to the image, to the color. I mean, everything about the product is turned over and over again because it's a constant fight to try to keep up and to try to see how do you make it more appealing to the masses. You do get the capital, right? You get the extra promotion that the portal provides for you because afterwards it does become viral. There's this thing that the first quarter, you see how it happens, and then afterwards it takes off in many instances. And most importantly, I think the thing that you really, really get is the data. Now you know who are these people that somehow believe me in my product, but they don't even know me. Where are they from? What price points are they comfortable with? What colors do they like of the product, right? All of these things before you couldn't actually do. You were probably like manufacturing things and trying to figure it out with your marketing department and your designers and everyone doing their job in the abstract without actually ever talking to a customer. This really changes that as you're coming, to market with a product. And additionally, then this is true, if you saw in the earlier slides, we have about every day 70 countries fund something on Indiegogo. Now you have this open gateway to the world to say, hey, I have this product. And I'm going to go through some market validation examples, one of them which is very international. But there's this thing now. I have this product, and globally people can be exposed to your product, to your marketing, to your coloring, to your market validation, to everything that you've done, right? You're seeing, is my product global? Do people care about it? Where are they caring about it? Should I try to do things that adhere more to a more global audience? All of those things now happen real time. No longer do you have to wait, process, put something to market, and then keep a bunch of inventory because you didn't actually understand that people in Europe didn't they didn't wear blue in spring or something like that. So market validation, right? So we're big on market validation, particularly in our hardware space. The Scan-to-Do Scout is literally a tricorder, kind of like out of Star Trek. It is a medical device that scans your vital signs and tells you automatically, what is your heart rate? What is your blood pressure? What is your, what's your temperature, right? Now, when you think about it, in the abstract, someone would have told you that this was coming to market, and you would have probably not funded it, right? Because it just sounds kind of out there. But this is a really, really successful. They put a campaign. Their goal was to reach $100,000. They raised $1.7 million, and then afterwards went on to raise an actual round of venture capital, right? So now the market has validated this product, right? Now the venture capitalists, Mandie, are now hey, I love it. Before they were I don't know about it, right? Because it wasn't validated. This is another example that's very different, right? So Knixwear is a Canadian company that made intimate apparel. They made lingerie, right? And what they did was they put a campaign to see, are people interested in this intimate apparel, in this lingerie? and they were able to raise $60,000 and have like 2,000 different variations and colors and sizes and all this good stuff. Well, then afterwards, Hudson Bay, a Canadian company, took note, and then now they're going to put this line in their stores. So just a different spin. And then lastly, to the global aspect of it, right? Airtame is a company that just finished raising $1.3 million on the site. They were actually voted the best startup in CES 14, and they're out of Denmark, right? So now these guys in Denmark are able to like put something on the market and figure out if there's a market for it. Again, continue to iterate their product, figure it out, find that there is really a big audience for them, and they were able to raise $1.3 million on our site. The next logical thing is that they will raise X amount of $1 million of venture capital. That's been pretty consistent. When you see these kind of campaigns that are this successful, it follows with venture capital. But now I'm going to give you a story of how this makes that venture capital round a little bit different and really empowering to the entrepreneur, right? Because there is a role of the VC, right? They're not all bad, right? There's a role for the VC in this, you know, for us entrepreneurs, and there's an important role. I'm going to give you the story of Canary. Now, Canary is a security system. They're actually out of New York. Has anyone heard of them? So they're actually out of New York. They do some really, really cool security, like home security. And basically, they raised $2 million on Indiegogo, right? They put their idea, they raised $2 million. Their goal was $100,000. They didn't want to do crowdfunding. Like, they did not. That wasn't their thing. They were not going to do crowdfunding. They were basically forced to do crowdfunding. And good for them, right? Because normally, and I'm going to walk you through their process, right? So they had an idea, right? They did their prototype. They knew they were onto something, right? And normally, as entrepreneurs, the next logical step is, you go try to get some VC funding, right? You have an idea, it's been validated. The VCs are where we normally would go to, whether we want to call them angels or whatever. If the VCs like you, right now they've validated that one person or group of people, very small group, has validated your idea and said, whoa, you know what, you're going to get offer letters. In their case, they did. They got offer letters, a few. The problem with the offer letters that they got was that it wasn't enough money, right? So the founder, you know, loved the fact that he got the offer letters, and normally in the past, before crowdfunding, you would have probably had to take the highest bid of those poor bids, right? That what he ended up doing was saying, okay, you know what? I'm not going to accept any of these bids, right? I'm going to try a different route for my product because I feel that this is too low, right? So what he did was he went ahead, he went on Indiegogo, and then the crowd started reacting because it's a great product. He knew it. The venture capitalists knew it. They were just off on price, right? But now there's buzz. Now this company is generating all this stuff, right? So what's the next thing that happens is something really remarkable. Those same VCs that said no to his original request, one of them actually called like an advisor and said, hey, what is the bank account number for Canary? And they went ahead and wired the money and sent them an email saying, hey, we wired the money per our agreement. And the guys were like, wait a minute, no. Like, this has changed drastically. Those terms are no longer the terms under which we're going to raise money. That's not going to happen. So obviously they returned the money and then ended up making $2 million on Indiegogo. And then afterward, what happened was they actually went out and got $10 million of venture capital money, but now on their terms, right? So the cycle is a little different now. These guys are more empowered. And to be honest, it actually helps the venture capitalists a lot too, because now they have validation too. They're taking less risk. Of course, this is not the case for every single product, and it's not the case for every single campaign that does crowdfunding. But if you're doing a product that is a tangible product and you want to get market validation and you want to give the VCs comfort, what better way than to say thousands of complete strangers that have never seen this product are willing to pay money for it right now, right? And I need $10 million to actually make it happen now, right? So the paradigm has really changed, and we do feel that it really empowers both sides of the equation. But there's a bunch of those stories now, right? Where you got the famous Oculus story, and there's a bunch more on Indiegogo that are very, very similar, of ideas that have been validated, and that then go out to get VC funding, I think is a natural thing that's happening, particularly in crowdfunding projects that have a tangible good. I think where we see this going, and a lot of the panels earlier talked about it, and Indiegogo in particular is going to play a role in it, is what happens when equity crowdfunding comes in. And Alejandro, who was here earlier, said, we were talking, and he said, hey, well, it seems like that crowd and my crowd are different. The crowd that goes for your products and the crowd that's going to be in equity crowdfunding are different. How are you thinking about it? And I said, well, when you think about it, I think about it, well, first of all, we have to understand that equity crowdfunding and Title III and the Jobs Act right now is a work in progress, and it's going to take a very long time for this to work efficiently. In my opinion, it's going to take years, right? The SEC and the government, God bless them, but they're going to make it really, really hard for a very, very long time, and it's going to take a lot of changes and iterations and pushes for that to happen, right? Nonetheless, we're really believers that this is the future, and one of the ways we think about it is what I call the story of the future lemonade entrepreneur, right? So at Indiegogo right now, what you have is, well, you have this right now. You have idea to platform to people to the lemonade, right? I love the flavors of the lemonade. We're going to get it. And right now, that's the transaction that happens. It's very much like just for the product itself. But what we found, particularly in Oculus and in Facebook, where there's a crowd of people that actually supports your product, and then you go out, turn around and make a bunch of money, those people actually feel cheated because they believed in you when no one else did, right? This is going to give you, or the entrepreneur, the chance to say, okay, you believed in my lemonade. Now if you believe in my company, you get a chance to actually participate in that same company and actually be a participant in the upside of the equity side of this great company that's going to be billions of dollars in the future. And that's really like the circle of like involvement from someone that believed in your idea and your lemonade when no venture capitalists would ever give you money to buy another lemonade stand. These complete strangers did. Hopefully, the hope is that in Title III and when it's actually all the kinks are worked out, those same people will be able to benefit from your idea as you grow a huge company. So that's kind of like where we see kind of like the new frontier. And that was my presentation. Thank you very much for having me, and it's been a great day.
And thank you for being on time. The next presentation is by Ethan Mollick. Ethan is a professor at the business school on Locust Walk in Philadelphia, known as the Horton School, I think. And Ethan is their local guru on crowdsourcing. And in addition to that, he studies early stage innovation in companies, in particular what makes innovative companies successful. And he was nominated one of the 40 top business school professors under 40. Welcome.
So thank you, guys. So I'm going to, so nerve-wracking to have a crowd that's like partially academic and partially not. So I'll try and cut right down the middle and make everybody slightly unhappy. So what I want to talk about today is about crowds. And I'm going to use crowdfunding to talk about it. I'm going to talk about a bunch of research projects that have yielded results, some of which are papers, some of which aren't. And what I really think about is, we're all here talking about crowds, and the fundamental questions that keep hearing asked over and over again is, why are crowds good? What makes them good? Right? And I think some of us have in the back of our mind this sort of wisdom of crowds idea, right? James Surowiecki. Now, I think this is great. I think crowds are often wise, but there's another sort of crowds title that came out 150 years before called The Madness of Crowds, right? And so just as we have examples of crowds being wise and smart, we have lots of examples of crowds turning into witch hunts or into tulip buying markets or bubbles. So what is it? I mean, what makes a crowd wise or mad? When is it wise or mad? Especially in crowdfunding, right? And in crowdsourcing and all these other things. So I want to present 3 studies I've done with 3 separate people that talk about when crowds are wise and when they're mad, and kind of give you the results we have so far. So I'm going to talk first about when we compare crowds to experts, who sort of ends up on top. I'm going to talk about crowds and discrimination. And then I'll talk a bit about the long-term success of crowdfunding and some of the follow-up data we have. And all this data is derived from Kickstarter plus other things, and I'll explain as I go along. So let me talk about crowds and experts. So there was a big deal in 2012, which was the first year that Kickstarter started giving more money to the arts than the National Endowment of the Arts did. Right? So Kickstarter is now a bigger funder of the arts than the NEA is. So big question there. What do we gain and what do we lose by moving from purely expert-based to crowd-based? Right? And so with Rotman and Anindya at Harvard Business School, we set out to answer that question. So we got together a group of judges who were NEA judges or judges of other top grant competitions. And we put together judging criteria based on the NEA criteria. So judging projects based on artistic value, based on community impact, based on innovation, based on feasibility, a whole range of different scales. And then we had those people judge Kickstarter projects without knowing what the outcomes were. And we had them do 120 different Kickstarter projects, and each one saw the same combination of big successes, big failures, and places somewhere in between. And then we actually also followed up with all those Kickstarter projects to find out what happened later, right? So not just did they fail or succeed, but what were the long-term outcomes? And so this is what we found. Crowd and experts actually agreed about 60% of the time. And so the projects that were most funded by the crowd were also the ones most liked by experts. So these two curves here, the dotted line curve is the average score assigned by the judges to projects that succeeded on Kickstarter. The solid line are the projects that failed on Kickstarter, right? And you're going to see there's a pretty distinct difference, right? 60% overlap in an area like theater, right, which is an area where you'd expect there to be a lot of subjectivity, and there's a lot of research showing there's a pretty big gap between what expert cultural opinion is and what critics say and what crowd or market says. So the fact that you had that kind of overlap suggests there's something interesting there. Now, we also looked at the edge cases, the cases where people didn't agree, right? And 75% of the time when there wasn't agreement, it was because the crowds funded something that experts wouldn't fund, okay? 25% of the time the experts funded something the crowd wouldn't. We can't say much about what happened with the ones that the expert funded, except to say there's still room for experts, especially in funding larger projects and so on. But in terms of funding, in terms of what happened to projects funded by the crowd versus projects funded by the crowd and experts, we actually can't find much difference. So we tracked what happened with all of these. There's some suggestion that the projects that were liked by both the crowd and the experts, right, that were mutually agreed on, were sort of low-risk projects. Almost all of them ended up being successful within different bounds of success. So they all premiered. None of them failed to put their play together or their musical or something similar. Some of them got reviewed by the New York Times. Some of them went on to sell quite a few tickets. Interestingly, on the ones that just the crowd funded, there seemed to be more variation. So of those, 2 of them turned out to be hits. One of the ones the experts hated ended up having a very successful off-Broadway run. Another one the experts didn't like ended up winning several New York Theater Innovation Awards. And there were also a couple that were abject failures, including one where the review read, this was a New York Times review, I tried to think of something I liked about the play when I was leaving, and I realized that the graphic design on the posters was quite nice, right? So there were some failures too, which I think points to the idea that the crowd and experts generally agree, and perhaps what the crowd is actually doing is lowering the barrier to entry somewhat, in a good way, right? Not just randomly, because we followed these people up. Quite a few of them were funded by friends and family. All the usual things you'd expect would cause problems here didn't seem to, right? So a lot of agreement between crowds and experts. So to that extent, there seems to be some wisdom in the crowd, right? And when we do a direct comparison, even this difficult case of theater, right? So that's one example. Let me talk about a second case. So, 2 more examples. So I've done some studies looking specifically at the sort of more VC-ish world of crowdfunding. So projects on Kickstarter in the technology, design, video game space. And trying to understand, are the signals that the crowd's responding to rational or not? So went through a whole bunch of projects, 1,200 projects, and had a whole bunch of people go through them as RAs and code them about whether or not they showed signs of endorsements from third parties, right? Did it have TechCrunch loves my product, right? Did they have a team with experience that had done this before? Had they produced a prototype? Did they have detailed plans? Did they have a lack of spelling errors? Right? It turns out a spelling error decreases your chance of success by 13%, all other things being equal. Did they provide frequent updates to their crowd, right? Something anyone else recommends. And I thought I'd also look for some signals that were sort of orthogonal of quality, right? That would be strong signals but wouldn't necessarily indicate a product that was going to succeed. And in those cases, I thought, okay, let's figure out what does the internet like that doesn't make sense. They like cat videos. They like bacon. So we looked for people mentioning bacon or having cat videos. We thought about in-group identity, people self-identified as geeks or nerds, and then pop culture, Star Wars, Star Trek, My Little Pony, a whole list of other top television programs and so on. And what we found is, universally, the signals of quality seem to predict success in crowdfunding campaigns, and the signals of orthogonal quality, with the exception of calling yourself a geek, which seemed to help, didn't. So all of this evidence seems to point out that the crowd is reasonably rational in terms of how it's thinking about assessing a product quality. So it's not that people are just herding or stampeding. There's other things going on, and there seems to be some rationality, more wisdom than madness. Right? And now, we tend to compare ourselves to experts and say, okay, experts really know what they're doing. Venture capitalists, for example, are experts in funding companies. But there's biases associated with experts, too. And particularly in the case of VC and funding of companies, one of the more famous of these is a bias, a gender bias. All right, so this is work with Jason Greenberg here at NYU, go NYU. There's a lot of evidence that's really depressing showing bias against women raising capital. So women make up 40% of all business owners in the United States. They make up 1.3% of founders of VC-backed companies, right? There's a huge, huge gap. Now, some of the, what the cause of that gap is many different things, right? There is the idea that there's already an old boys network that they can't plug into. Women tend to start different kinds of companies than men. There's also clearly misogyny going on. There's a lot of factors mixed together, right? So what we wanted to figure out is the crowd, will that do better, right? What happens with discrimination in the crowd? So we looked at 1,200 projects and 250,000 backers to try and figure out what was going on here. And we chose them from different categories, right? We chose them from categories where women were more prevalent. In this case, it was fashion and fashion startups and children's books. So we chose areas where women were much less prevalent, like video games and technology, and somewhere in the middle, like film. And here's what we found. Right? The blue line are female-only projects. The red line is the overall average, and the tan line in the middle is male-only projects. Right? So what you find here is actually the biggest gap where women are most successful is in technology. All other things being equal, female-led projects, these are projects raising over $5,000, so larger projects. Female-led projects succeeded over 40% of the time. Male-led projects succeeded over 20%. So this seemed kind of baffling to us, right? Which is this. Can you say that again? That's that. So female-led projects in technology succeeded over 40% of the time. Male-led projects in technology succeeded just over 20%. There were many fewer female projects, but they were much more successful, right? And this is controlling for, when you control for all the factors in place, women are on average 13% more likely to succeed than men on the margin, with everything else being equal. Success here is getting funded. Yeah. Getting funded, yep. So this is not long-term, okay? So the question becomes why, right? And especially why is it at the area we'd least expect to see this happen? Technology, where women are most underrepresented. They make up the smallest proportion of backers there and the smallest proportion of projects. And so we decided to actually do an experiment to figure this out. So what we did was we took one of the most popular technology projects on Kickstarter and one of the most popular fashion projects, was showing you one of these. And we randomized for a whole group of experimental subjects who created the project. We took this picture of women and men, and believe it or not, neuroscientists have found these are people, equally attractive individuals, apparently. This is based on, there's an attractiveness scale. And we used the names, the most common millennial names of Jessica and Michael. So Jessica and Michael Smith. And all that varied between these projects was whether you saw Jessica Smith or Michael Smith, right? Otherwise, the projects were exactly identical. And what we found was, just like we had found before, men didn't seem to care. So there wasn't a bias for men or against women from male backers. And in general, there wasn't a huge female effect, except for women who identified themselves as activists. That is, women who cared that you should support other women and that believed that women were being underrepresented in technology. Those people were driving almost this entire effect, right? So it turned out that the activist women were able to get around the gatekeepers that had been holding them back. It wasn't just about representation. It was about people actually stepping up and saying, I want to support these people for reasons that matter to me, which I think matches nicely with what our last speaker found. And that was the reason why women were being more successful than men on Kickstarter. So I think there's something really interesting here about the democratization and the many reasons why people do crowdfunding. And it's not just about representation. It's not just about having more women. It's about having women who are actually actively helping each other. And that seemed to actually explain about what's going on. How much time do you have left? 5 minutes. Okay. So I'll give you one more set of things. So this is on the long-term impact of crowdfunding. And this is based on follow-up studies we did of what happened to projects a year or two after they came out. So we surveyed everybody who had made a successful project in technology, video games, or design. Again, the more kind of product-focused things. We have some for film and theater too. I won't present those here. And we asked them a lot of questions. Among the things that turned out to be really interesting was of the projects that answered, and we had a very high response rate and no biases we could find, 90% of them were turned into ongoing ventures. Right? Doesn't mean it was full-time. 90% of them were still going on. And of those, 33%, almost a third of them, reported yearly revenues of over $100,000 from their campaign, right? And this is after not counting additional crowdfunding money. What was also interesting, I think that we heard about the same thing from Indiegogo a few minutes ago, is that it turns out that raising money was sort of the fourth most popular benefit of crowdfunding. So this is based on, this is none, a little, sum, a lot, the various benefits of crowdfunding. And so the people we surveyed found that developing a customer base was actually more critical than raising money in many cases. Getting press attention was more important. And some people, quite a few of them, did raise additional funds. I'll have to look at the exact numbers. All of this is online, and you can check my paper on it. But there were a huge amount of benefits to people other than just raising capital, right? And crowdfunding was really unlocked those benefits for people. We also talked about sort of fraud and delivery rates before. So we actually tracked when projects actually delivered. And it turns out that about 75% of projects are late. And the more money you raise, the later you are. So these are the delivery curves, right? And it shows you the percentage of delivery months after promised delivery. Now, as I said earlier, for those of you who are here, we found actual instances of fraud were very rare. So something, and this is Kickstarter, I can't talk about other platforms, but it was about 3.5% of the projects we found seemed to show signs of fraud. Doesn't mean they're fraudulent, the person could have died. I mean, honestly, we don't know, right? But they stopped responding on email, people were complaining about it, and there was really no trace of the project. But that represented less than 0.5% of the total money spent, right? So fraud was actually really rare comparatively, and it'd be interesting to talk a little bit more about why that is at some future point.
It's too early. They'll come, believe me.
So we could talk about that, but there's been a lot of we've seen a lot of cases of attempted fraud, and we've seen why they've stopped. So you know, fraudsters always come. There's advantages to being part of a community, though, and stopping that. Okay, and then last thing, and this, don't worry, you don't have to memorize this chart, and I have this posted up. But one of the things that becomes interesting for those of you who are kind of practitioners is there's all this research, both for me and other people, have sort of been looking at when do you get benefits from crowdfunding, what helps, right? So it turns out that to run a successful campaign, it helps for you to have the right background, to have the right endorsements. In other words, to do all the things you'd expect someone who's actually going to deliver a project to actually do. The more money you're looking to raise, generally the worse that you do. We didn't find much effect of having a business plan in advance, having a clear sort of plan, but being able to broadcast what you were doing and why you were the right person helped. In getting more money after Kickstarter, it helped, or after a crowdfunding campaign, it helped to have raised a lot of money, which I think is what we just heard in the last talk, right? The more successful you were, more likely you were to get follow-on money. And then business plans actually helped. So if you had a business plan, you're more likely to raise cash. And then getting additional benefits from the campaign, again, the more successful you are, the more benefits that you tended to get, and the more you were the right kind of people to execute in any kind of environment, the better you'd do. And then in terms of delivery, the only thing that helps is having a really clear schedule up front. And the more money you raise, the bigger your goal, the more likely you are to be delayed, right, for all the reasons of complexity and everything else. So, you know, I kind of feel a little bad as an academic that I keep finding good news for crowdfunding. I'm looking, you know, I feel like I'm feeling like I was shill at this point, right? Because I'm expecting to find more kind of qualifications that the crowd is actually insane at points. So far, I've had trouble doing that, right? Most of the indications I have is that the crowd is wise within certain boundaries, right? And this is in Kickstarter, which has this past the post kind of approach and a few other angles to it. But by and large, the evidence seems to be that the crowd seems to be wiser than it is mad, which is interesting because it could have gone either way. There's no reason to suspect that that markets work in these kind of cases. But that having the right kind of mix of dynamics and a large population helps. So if you have a much less looked at site, there's a good chance you'll see much more fraud and much less success. And I'd love to talk about any of this stuff further. I've got papers online you want to look at, comments, objection, and any of you who actually run crowdfunding sites who'd like to give up data or do experiments, I'm happy to talk about that as well. So thank you guys a lot.
The next speaker in this panel is Deborah Jackson. Deborah is the founder and CEO of Plum Alley and also of the Women Innovate Mobile Accelerator. Deborah had a long career at Goldman Sachs, and after that she found her niche in funding and guiding companies in early stage technology and medical companies, primarily founded by women.
To go.
Let's welcome Deborah.
Thank you so much. Hi, everybody. So, first of all, I want to let you know that I really enjoyed that last talk, because it was all about the sort of academics of this and studying it and trying to figure out if the crowd is wise or not wise, and who knows if the crowd is wise or not wise. We'll find out over time. But I'm actually a practitioner, so I came from the field of raising money. I went to Columbia Business School, and then I went to Goldman, and I worked on Wall Street for 21 years, raising money for companies in the public markets. And my last stop was in healthcare technology, so I became very involved with hardware companies, software companies, and internet companies. So after that career, I left Wall Street. I became a very active angel investor in early stage companies. And so I had the chance, from going to a big corporate structure to going into the fields and actually working with early stage companies. I mentored a number of companies. And then I thought, I want to become more active. I'm not ready to retire. I really need to do something more. So 3 years ago, I founded a company, Women Innovate Mobile. It's an accelerator company that invests in mobile technology. And that company is still out there doing things. But I also founded a second company, Plum Alley, which is what we're going to talk about today. So Plum Alley started 2 years ago. It's a company that profiles women entrepreneurs. And so far we've profiled over 100 women entrepreneurs, and you can buy their products for sale on our site. So we're very much in the space of women entrepreneurs who actually have companies and helping them get more sales. So we've been around, and of course with my background in finance and on Wall Street, it became very clear to me a lot of the companies that we were working with needed additional rounds of capital or needed capital to launch new products. So we decided, we watched Kickstarter very closely, and one of the things that I learned at Goldman was you don't have to be the first in the market. In fact, sometimes it's better not to be the first in the market. Let someone else carve the way a bit and find your sector and service them very well. So I watched Kickstarter, honestly, and I said if they reach 300 million in pledges, we're going to launch a platform for women entrepreneurs and women's projects. And so we did that. We went live in October of this year with a handful of projects, and I'm happy to say that Forbes recognized us as one of the startups to watch this year because we're about women entrepreneurs, women creators, and crowdfunding. So we heard this a little bit earlier. Yes, women entrepreneurs tend to be underfunded compared to their male counterparts. If you look at the data here, females in the U.S., women entrepreneurs in the U.S. over 8 million, and roughly 5%, depending on the data, gets funded. That's pretty dismal. So of course I saw that as an opportunity. I said, well, if women aren't getting funded and they've got companies, and I'm seeing all these fabulous companies, why don't we help them get money through crowdfunding? So you probably heard this a lot today. Crowdfunding fits, the way I see it, because I'm from Wall Street, crowdfunding fits in the very, very early stages of capital raising. To me, it's just another new way to raise money on the spectrum. So a lot of people ask me, because we started off with e-commerce, well, why are you going to do crowdfunding? And it's to me, they're very integrated, because so many of the women that had fabulous companies and products wanted to raise money to launch a new line or a new product. And on the other hand, some of the crowdfunding campaigns that came forward and were successful, those companies said, gee, I'm actually not a company yet, and I don't really have a distribution e-commerce outlet. So can I be part of your e-commerce platform until I build my own? So I see the two activities as very interrelated. In fact, Indiegogo, I know, has been talking about possibly coming up with some kind of e-commerce platform. So I feel like we started it that way, we're moving in the other direction. So what is our competitive advantage? And one of the things that we thought is our audience is primarily female. In 1 month alone, we had 140,000 unique visitors with no spend at all on advertising. And so we are very much tapped into a network of women entrepreneurs, and that is a very engaged network. I think that's part of the reason that we heard that those campaigns are successful. Women are the most active users of social media on every platform, so when a campaign goes live and you tap into connected women, you're going to reach a lot of women. So our platform also, it breaks down, I think, by gender. The projects that we have on our platform, they're obviously launched by women. They tend to appeal to women. So if you have a clothing line or a new pair of shoes or a handbag, that is something that's obviously going to appeal more to women than to men, unless they're shopping for gifts or something like that. But, you know, our projects really do appeal to women. And finally, we offer an e-commerce solution in a seamless way. So here's just a couple of examples of successful campaigns that we've had, and I'd say our campaigns have been in the range of $25,000 and up. They are larger campaigns. Our contributors are generally $100 or more, and we have had a 78% success rate of the campaigns we've had so far. Now, obviously, we don't have as many data points because we're the new kid on the block, but you heard earlier that Kickstarter's success ratio is something like 44%, Indiegogo's is something like 34%, ours is 78%. So here's a woman athlete. She had a campaign to launch a new vitamin water. It was successful. It's now in Whole Foods across the country. This woman is from Silicon Valley. She introduced a new clothing line, took pre-orders for that, it's successful. Here's a couple of other projects. We had a woman who launched a tech training program to teach women how to code. That was successful. That actually went viral over a weekend. She raised $1,000 every 30 minutes. It's now covered by the New Yorker magazine because it was so interesting to them. And a woman who had an art project. So we have three buckets. It's women entrepreneurs getting pre-orders, it's women in the arts and media, and finally, not-for-profit organizations that benefit women and girls. Now, I will say some of the traffic that has come to our site, we have about 20-25% men, and interestingly, on our e-commerce platform, our biggest purchasers are men. And honestly, I don't know how they found us, but we're really glad that they do. I think it has something to do with the fact we have very curated products. So if you buy a gift or a product, not only do you know you're going to get a good product, but also you're going to get brownie points for supporting women entrepreneurs. So I think that might be the end of the slide. So one of the things that there's a study, and I appreciate all the comments that were made earlier, but there's a study that was just done by the University of California at Berkeley that looked at Kickstarter projects and concluded that it really broke down by gender. And that was because people tend to fund projects that they're interested in. So when you think about it, there was one very successful project on Kickstarter, which was, I don't know if you guys and women saw it, but it was basically a pair of undershorts for men, but it had this amazing space where you could put a flask in it. And I just randomly found this one day. I was checking out Kickstarter, and I said, wow, that's kind of an interesting product. And I thought, well, I'm not going to buy that, but I can imagine a lot of guys would buy it. Well, that pre-order of that product raised over $1 million. And I said, that's it. You know, I get this. It totally will break down, most of it by gender, unless you're getting a gift. And so I realized, okay, well, when you look at the breakdown of Kickstarter, the demographic is 75% men. If you Comcast, if you look at the data that's out there, the traffic and the interest is predominantly men. And of course that would be, and I'm not knocking it, I think it's a beautiful thing, but it does break down by gender. And so we're the platform. I'm happy to hear that there is that difference, because I think this reward-based crowdfunding is not one winner takes all kind of market. I think it's new. I think what you'll see over time is that market segments, and it will be really important to have your audience, know your audience, serve your audience, and build communities around that. So, happy to answer any questions. Obviously, we're not doing equity crowdfunding at this point because I come from Wall Street and I know what's involved in that. And I think it's a little bit early for us to move into that space, but over time, you will see us do that as well.
Deborah, we'll have questions at the end after all of the presentations.
All right.
So,
thank you.
The next presentation is by Gordon Burtch. Gordon is a professor at the Carlson School of Management at the University of Minnesota. He's an expert on the factors that drive behavior in online and social settings, and both economic factors and psychological factors. And he's going to talk to us about how peer referrals in crowdfunding affect conversions.
Thank you, Yanis. So happy to be here, wrapping up the day for you. I won't keep you long, I promise. We can get to drinks later. There is a reception, I think. So I'm going to be talking today about one of the most recent papers we've been working on, which is taking some data from one of the leading crowdfunding platforms. You may figure out who it is when you see screenshots, to try and understand how or what drives people to act on a referral when they receive an email or a tweet or a Facebook post from their friend about a crowdfunding campaign on this website. When are they more or less likely to act on it and give money as well? But before I get into that, I just want to step back and say a little bit about myself. So I am a professor in the Department of Information and Decision Sciences at the Carlson School at the University of Minnesota. This work is joint with my colleagues here, Anindya, Ghose, and Sunil Wattal, and we actually have a number of papers in the crowdfunding space that we've been looking at this for a number of years now. So first got into this back in 2009, working with a little company called Camisa, based out of Chicago, who has since gone out of business, but they were one of the sort of forebearers of a lot of the companies in this space and kind of got us thinking about a lot of the stuff that's going on here. And one of the main things we started focusing on is this notion that people can observe what other people are doing on these platforms, and they're highly social in nature. As Yanis said, I've been really focused on how people are driven by social aspects of various websites. So we're trying to understand here, this is just one study in a broader portfolio of work, trying to understand how does visibility of other people and their actions impact people's behavior. So our initial work looked at a website called Spot.us, and we tried to understand peer influence on that website, and we actually found evidence that the crowd is somewhat wise in the sense that as they see a campaign succeeding massively and getting lots of funds from other people, they tend to withhold their money and take it elsewhere to help somebody else. So that's what we found there. Here, what I'm looking at is how does what the referrer who sent me this email or this tweet, how does what they've done in the past in terms of giving money publicly impact my probability of giving money to? Okay, so that's the general notion. So what are we talking about? So we're talking about this type of thing. So we've all seen a page like this before of a crowdfunding campaign. And at the bottom, usually on most of these platforms, you're going to see something along these lines that allows you to share this thing, right? So you can put it on Facebook, you can tweet it, you can send an email, you can put a widget up on your website, whatever. So this is what I'm talking about. Somebody comes, they either give money or they don't, and they take this action and tell their friends about it. So I'm just going to start off so you know what you're taking away from this, what you should learn from me. These three things. So first off, referrals that are sent by somebody that has themselves given money already are way more likely to drive somebody else to convert. And there are a number of reasons you could think that could be true. I'm going to talk about the two that we've identified, we think, and we rule out some alternative explanations here. It may simply be that these people are putting in more effort to convert other people. It may be that they look like they're putting their money where their mouth is, so they're more credible. Those are the two things that we focus on in this paper. So this is the second piece. Public consumption matters as well, so public prior contribution by these people, as opposed to concealed prior contribution. And I'll explain that in a second. It matters because if I can see that this person has given money in the past, that means I have both of these options. So one, maybe they're more credible because I can see what they've been doing, and two, maybe they're putting in more enthusiasm at the same time and trying to convince me. So these public prior contributions should be stronger in their impact on me than the ones where somebody has given in advance of referring me, but they concealed that contribution and I can't observe it. So that's where we're getting this identification. We're able to quantify the difference. How much more effective are these referrals where somebody gave money in the past before they referred me and I could see it? Okay, so that's our main goal here. So as I said, why does prior contribution by a referrer matter? So it's useful to think of an example. Okay, this is based on a long stream of literature in marketing around word of mouth. All right, so a lot of products are dependent on word of mouth to further adoption and diffusion in a marketplace. Here we're viewing crowdfunding campaigns as sort of like a product. And when somebody gives money to the campaign, that's sort of like they're engaging with it or adopting it, okay? The difference here is the amount of money that they give is almost a continuous indication of how much they're approving of this product. So here we're trying to understand, as somebody gives money to the campaign, on the one hand, again, they may put in effort. Now, the analogous example from the marketing literature that has come up recently is if you look at physicians and how they prescribe drugs, and how other physicians respond to that when they hear about the drug from this person. High volume prescribers are more likely to convince other doctors to start prescribing the same drug. The reason being, one, they may be more enthusiastic in telling other people about that drug, and two, they may be more likely to be viewed as an expert or somebody that's credible in giving this advice. Here we're saying somebody that has themselves given a lot of money to a crowdfunding campaign is maybe more likely to try harder to convince other people. Maybe they are more likely to tailor the message that they're sending to somebody. Think about the relevant information that this person's going to care about when they send them a message. Maybe they'll be more selective about who they send the message to, right? So all these types of strategies, they may be more likely to practice when they are really heavily behind a campaign and its cause and what it's trying to get done. The other thing is endorsement. And just so you understand what this picture is of, in case it's not obvious, a lot of this literature is rooted in this notion that when you see a whole lot of people lining up at a restaurant and you've never been to that restaurant and you don't know anything about it, you may be more likely to think, oh, it's something I should probably go check out too. Everybody seems to like it, right? If I see this person's referring me and I go and look at this funders tab on the campaign and I see this person's given $1,000, they really seriously believe in this thing, then I may be more likely to buy it too or invest in it as well. So this is what I'm talking about, all right? So you have what are two effectively identical contributions to the same campaign. One was made anonymously, the other was not. These two people could have both sent a referral to somebody. When I arrive, I can observe the funder tab and I can see, in this case, yes, this person referred me and I can see that they gave this $50. The other person, I show up and I don't see any evidence that this person's given any money. So this is where the difference is coming from. This person, their referral can impact me because I may view their contribution as a sign of credibility, that they're implicitly endorsing this thing, and that they're putting their money where their mouth is. And at the same time, they may also be trying harder to convince me because they put in X number of dollars. The first one, only the effort effect is possible. I can't see what they gave because I can't identify them. So really, we can infer that the only results that can derive from that are the effort they're putting in. So the way we estimated this, we got a rather large data set from this platform, 42,000 peer referrals. And basically the way these are defined, the unit of observation is anytime somebody showed up on this platform at a URL, we were able to identify from a parameter in the URL they followed who sent them. So where did they find out about this thing? Because it gets baked into the URL when it's shared. So we have 42,000 instances of people arriving at a campaign where we know who sent them, what's the name of the campaign, or what are the campaign details, and what did they do at the end of the day? Did they leave or did they give money? All right? These are issued by 14,000 unique people, and we did a lot of, well, I don't want to get too heavily into the math, by the way, but some fancy econometrics to rule out a bunch of important control variables here. And basically what we focused on, first off, did the person that sent the referral give money to the campaign before the person acted on it? 2, how much did they give? And 3, was it revealed? So this is basically what the math would look like in simple form. So our outcome that we're trying to understand here is, first off, does the recipient of the referral end up being converted? Do they give money? 2, how much do they give? And does that increase as the amount that was given by the referrer goes up? So basically, as I see you being more and more implicitly endorsing, and maybe you're trying a lot harder to convert me, I also give more money. And number 3, what happens in terms of transaction durations? What's going to happen here is basically we find that the more and more money that the referrer has given to the campaign before I show up, the more quickly do I go through the transaction process. Basically, I spend less time thinking about it and worrying about it. I'm that much more convinced, and I just get this thing done and I go. OK, so our results. At the baseline, referrals that were issued by people who had given any amount of money, a binary amount, whether or not it was revealed, are 44% more likely to result in a conversion by the recipient than the alternative, which is somebody that didn't give any money. Number 2, public contributions, so those prior contributions by our referrer that are publicly visible to people, are 30% more effective than the case where they gave money but they concealed it. Okay, and number 3, for every 1% or for every 10% increase in the amount of money over the average that the referrer gave to the campaign, we see a 1% decline in how long it takes them to finish the transaction, the recipient. All right, so just to summarize, referrals from converted people are way more effective than referrals that are attempted by somebody that hasn't given any money already. The effect is much stronger when it's publicly revealed. So basically, we want, as a campaign organizer, to somehow incentivize people to go out and refer their friends, and particularly those people who have already given money to the campaign, and publicly so. And number 3, we have some sense that the reason this is happening is that these people that are receiving these referrals are more reassured in some sense because they see this person, again, drinking the Kool-Aid or putting their money where their mouth is before they get the referral. Okay? And that's all I have for you today.
Thank you very much. I would like to invite the panel to come forward. So Sinohi, Ethan, Gordon, Deborah, and we can take some questions. And I will. So the first question I want to ask Sinohi, but I don't. Here you are.
I'm walking down.
Yes, we talked about some of the issues that you guys talked about, and also we talked about throughout the day, are related to quality control, avoiding delays, possibly preventing fraud. Now, these are not issues that we haven't seen in markets before, and eBay comes to mind, and the way that eBay addresses these is through a reputation system and for both sides of the market. And I was wondering, do you see this type of a system emerging in crowdfunding, where we could have, let's say, reputations both for people seeking funding and also for the backers? And what could be the role of that? So let's.
Yeah, I mean, it's a very interesting problem for us because we are an open marketplace, so we don't do any curation. So I think that the problem is even exponential for us. But I do think that just generally, so the social graph that people have has evolved to a point that we can get comfort really, really quick about who people are. There are things that people cannot game as easy, right? So we had a great example that was in the press where we had basically a campaign out of Russia, and Pando Daily decided that it was complete fraud, and I mean they went to the mat for it, and they have their right to do that. For us, what we did was we were fairly certain that this person existed, that he was a real person, that we looked at exactly how he built his reputation online, whether it was you don't just wake up one morning and add 600 LinkedIn, people to your profile, right? There are things like that that now take a very long time for you to build. So our approach so far is more to focus on making sure that we understand that these are people, that they live where they say they live, that their bank account ties to who they are. There's a lot of information now. It's kind of like scary NSA stuff where we don't even know how much is out there about ourselves, and there's a lot of power in that. So for us, we see an eventual place where you will have kind of like a trust badge, right? Which is you are somehow certified as a trustworthy individual, and we see companies like that pitch me every day because they got this next product that's going to be something like that. But there will be an evolution. It's going to be hard. Because delivery is always going to be something that's going to be challenging. But as far as pure fraud, which I think was determined earlier, someone said there's very, very few instances of fraud. There may be poor quality and things like that. And I think that crowdfunding is going to continue to evolve to try to protect people because it's all about trust. At Indiegogo, trust is #1 thing. The word trust, which is different than fraud, right? Because fraud rates are low. But trust has to be high.
To build on that, as we move from, let's say, markets for products or funding, let's say, theater projects, could it be, as we move more to equity, crowdfunding, then some of the validation that Sinohi talked about, or wisdom of crowd processes, like the agreement between the experts and the people, I mean, maybe a little bit more of an issue. Because if you think, if I'm funding a theater project, maybe the fact that someone goes to see the play, it's a pretty good signal for quality or potential market. But when it comes to funding startups with equity, this is something where you could argue that your typical average user may not have expertise. So to what extent is this a concern as we move from to equity-based crowdfunding?
So I think that's a real issue because having come from Wall Street and working with disclosure and thinking about disclosure, in order for somebody to make an investment, you have to have the proper information. And especially if you're doing early stage investing, I can speak as an angel investor, you actually want to meet the person. You can look at the data, you can look at their projections, but you actually want to sit and have coffee or dinner with that person to get a sense of that entrepreneur. So I personally think it's a little bit riskier than doing a reward base where you get something and you're not expecting to live with the company forever. So I think it is an issue. And that's why you see right now you've got sites like CircleUp and AngelList where they have approved accredited investors that are investing on their platform. That is a little bit easier to get because those people are high net worth individuals and they are in a position to make those decisions. But when this opens up with the Jobs Act and once the SEC finishes their work, it really allows any person with kind of a modest amount of income to make an angel investment. And I think a lot of people are going to lose a lot of money because early stage investing is really dangerous. It's like buying a lottery ticket.
Yeah.
Most investors, expect 10 investments. You have a portfolio, 8 are going to, not work out, and 6 are not work out, and 2 will kind of break even, and 2 will make you return. So that's what the average person is going to be facing online.
Can I just comment on that? Actually, those statistics are derived from professional venture capitalists in their portfolio.
Yes.
So I think that it's erroneous to keep using that statistic because when people are just throwing money at unknown investments, they're probably going to have a worse result.
Yes, and I'm quoting angel investing groups like Golden Seeds and New York Angels and things like that, which are kind of professional, they're not just the average person. So yeah, it's pretty treacherous.
And yes, I think Ethan also has a perspective, and let me kind of build on that because you mentioned that you don't see fraud in the projects you studied, but when we move to equity type of projects, we will see the equivalent of the Boiler Room or the Wolf of Wall Street.
Right, so I think there's 2 separate things. There's fraud and risk, and those are different things. And let me talk about fraud briefly because I think risk is a longer conversation that we can talk about, but they're related. So I think bubbling through a lot of the presentations has been Linus's Law. Has anyone defined Linus's Law yet? Because I've heard it mentioned a couple times in passing in the outcome. So Linus's Law comes from Linus Torvald, the inventor of Linux. And the expression that Eric Raymond used about Linux is, with enough eyes, all bugs are shallow. That means if you have enough people looking at a problem, it's going to be trivial to someone. That's the whole sort of mechanism behind the crowdsourcing movement. It's the mechanism behind Kareem Lakhani's work. And I think that's part of why fraud gets stopped, is that you have enough eyes on the problem that if those signals can, and I think the one concern I have about Indiegogo is you need an authority who sort of says, okay, the signals are getting bad, I'm going to pull the brakes on this. So I think it's an open experiment to find out whether or not that whether that ends up being an issue or not. So I think that the advantage of this is VCs aren't magical either, right? All the good evidence now on VC research seems to show that they have incredible problems picking a big hit twice in a row, that it's almost all status-based, that the top VCs get all the returns and everyone else loses money. So I think that there's advantages in markets where people are part of that market, part of a community, and there's enough eyes on a project, you might actually find less fraud and more successful projects that aren't started by white guys with Harvard, or Stanford degrees, which tend to be predominant in sort of the VC world. So I think that there's a tension here, but there's, I think saying we're so worried about fraud, we're shutting everything down is dangerous too, because the current world is pretty biased also.
Right. The open source law, which is, I guess, not Linus' law, is that if there are enough eyes on all bugs are shallow if you get enough eyes on them,
yep.
Right?
Mm-hmm.
Now let me get Gordon's perspective, and actually you mentioned that the behavior of the basically referrer affects the behavior of the people that they make the the referral. Now, can you also, in addition to your perspective, comment on the fact that this can start what we call information cascades, or also known as herd behavior?
Sure.
And
sure. So actually, I'll just start off by commenting just a little bit on that last point. So one thing to keep in mind is not just about when equity crowdfunding starts in the U.S., because it's already kind of going on some platforms, just only with accredited people. And I think even the comparison between accredited investors partaking in online investing of this sort compared to the offline or venture syndicate approach, there's already a stark difference there in terms of the access you have to information about the person, right? Because there's geographic separation. In the past, you also had to be able to know this person. There was no public advertisement of these things, right? So Title II is already passed. It's in place. I can go on Twitter and say, come buy a piece of my private company, right? You don't know me. We've never met. We probably never will meet. So how much can you really know about me, and how much can you properly evaluate my company? So there's already this additional information asymmetry that's happening. So these reputation mechanisms, sure, that's one approach. The other thing that's been talked about earlier, I think, was the fact that you can tie to a real-world profile, right? Airbnb does this. A lot of these sharing economy type platforms are doing this to help mitigate the problem. So that being said, yes, I also agree that there is a huge potential for bubbles to start. So you may be familiar, there was, I can't remember the exact case, but at least in February or so of 2013, it came out there was this company that essentially would buy you a spot on the New York Times bestseller list for your book if you asked them to, right? And the whole goal of that was that once you get on that list, everybody sees it as a source of validation because everybody else has already bought your book, it must be good, I'm going to go buy it too. Okay? So if you're in this situation where, as we've shown, there's a lot of peer influence that happens, it may be negative. We have shown that in another paper that there's a substitution effect. But a lot of the time we've shown it's actually positive. And other people have shown this too in peer-to-peer lending. If this is going on, there is a huge potential for a bubble to happen. So yes, I do agree with the general sentiment that if there are enough eyes on something, then all bugs are shallow. At the same time, if there are enough eyes on something, people may miss the point, right? And then the bug gets really deep and becomes a huge problem. So it's not necessarily guaranteed to be self-resolving, I think.
But the one thing, though, I just want to make about the all eyes on we'll find a bug, or however that's phrased. I mean, I think about that as the public markets. Think about it. You have public markets with stocks and research reports and investors every day, every second, watching the market, the information. So that's not necessarily a situation where the problems are ferreted out, or it's a clean, it produces a clean system. So it's, this is another financial market that's in its infancies, but it's very similar and will develop probably very similar like the public markets are today.
And I also think that at least the way that Title III is envisioned now, which I think is totally flawed because it's going to have too much constraint, is that because of the limits, a bubble, like in the term of like this ginormous bubble, is basically like sort of impossible. You can have a lot of little bubbles, right? Because there are limits both to how much an individual can contribute, but also how much the individual company can raise. It's not like they can go and raise $100 million. Matter of fact, there's more chance now for it to happen now in crowdfunding or anything that's out now, because there's an unlimited amount of money you can raise, than there will be in Title III, when the companies actually start raising funds.
Okay, but while we're waiting, I guess, for these rules to be drafted, let's open let's open the questions from the floor. I know Avi raised your hand even before the panel went.
So something Deborah said struck me, which is that you said we have 78% successes, and you were comparing and saying, hey, we're doing better at some level.
Yeah.
And I'm trying to think, is there an optimal percent success? Is there an aim that you should have in terms of percent success, or do you just want to, or are we striving for 100? What's going on here?
Yeah, I think it's really a company's individual strategy. So, and it's just like accepting all projects versus curating projects. So it's a strategic decision of a company. We are very strategic. We do not take every project. We work a lot telling our project creators, you know what, that goal is too great. We don't want to see you succeed because we believe there's no advantage for anybody. If you spend your time and have a failed campaign, it's a drag. It's a drag for you. It's bad for the company. So we want to keep our numbers up there. I don't know if we will succeed, but we have some very specific things we do. We have a metrics based on how many people you know. and the dollar amount you're going to raise, how likely you are to be successful. It's not that complicated, and I think if you do a proper campaign, you're probably going to succeed. I think what happens is a lot of people are naive. They think, oh, put it up there, people will come running, and it doesn't work that way. And a lot of it is your own network, your own work that you're doing, because platforms are, you know, increasingly getting bigger and bigger. So even if you've got a great campaign up there, the chances of you being discovered, unless you're, you know, hit a certain critical point, you're not even going to be on the front page.
Yep.
How are people going to find you? Kickstarter had 19,000 projects. Okay, so, you know, you're going to have to do a whole lot of digging. Sometimes you can't even find projects you want to find. So it's really up to the project creator to have a strategy, and I really think it's up to the platform. It's also some platforms, I know what happens is the crowd actually comes back and says it's not a question of fraud, like it's bad or incomplete information. It's a question the crowd will come back and go, that's a really crappy thing to do. So there was, you know, the one, I don't even remember which platform it was on, but there was one guy who was, you know, had some manual he was producing on how to, you know, drag women into bed and or something like that. And it was like the crowd started saying, wait, we don't want to see that project out there. So, I mean, I think that's not a question of fraud, but that's actually people saying, and then eventually that project was taken down. So that's a question of the community saying, you know, what if you know it's a legitimate organization, but it's a terrorist organization? There's no fraud there. They're saying exactly what they do, and people are funding it. Is that cool?
Let's try to get a couple of more questions in. We have one question from the back there.
In terms of research or like best practices, do you see entrepreneurs playing the field with so many platforms out there and offering, you know, try to raise money from a variety of different platforms at the same time?
Ethan?
So we actually have a little data on that. So there are people who launch simultaneously on Indiegogo and Kickstarter. There are also plenty of people who do it sequentially, so they launch and then launch again. I will tell you that if you launch the first time and you succeed, your chance of succeeding in future projects goes up by somewhere between 30 and 60%, even if you raise the amount you're going. If you fail the first time around, if you've raised, it turns out the number of Kickstarter is $350, then you're better off relaunching the campaign with a slightly less goal, and you have a good chance of succeeding. If you raise less than $350, you should not do the same thing again, and you should do a completely different project. And you're still not as likely to succeed as somebody fresh to the platform, but you have a chance. So, in terms of behavior, we see people are gaming in all kinds of ways. The community often gets very upset if you're doing simultaneous projects on different platforms. And especially since you were past the post in Kickstarter, it's strange to sort of divide your capital in that sort of way.
Okay, Ethan, I want to get 3 more questions in, so we'll limit you to 1 minute. Here. Now, you sir.
Hello. Yeah, actually along the same lines. My name is Alex Feldman from Crowdnetic, and I actually work with businesses trying to find the best possible platform. So I think the platforms bring a lot of value to the projects. One of them is actually how much funding can they bring outside the funding that the projects bring. So if you've said some of the stats, I'd love to hear it. And also any other value. Do you give them more exposure, marketing? If you're a small platform, do you work with them one-on-one to actually build a campaign? So love to hear like the value that you bring to the projects.
Well, I could start real quick. I mean, at Indiegogo, we actually, it's a very hands-on process for us because we really want campaigns to be successful. So we have 2 groups. We have a customer happiness group and then have a campaign specialist group. Usually when you go in, as you're going through your flow, the campaign specialist picks up your campaign and basically guides you and says, hey, this is what I think, this is how I think your campaign could be successful. And we really pride ourselves on basically like our service component. I do want to clarify one thing about success rate that's very nuanced, and that is that at our platform you can have something called a flexible campaign, which means you may not reach your goal, but you still get your funding, right? And something that I learned at Etsy is that success is a very funny thing. When people say, what is success? It really varies by people, because if you raise money just because you didn't meet your goal doesn't mean you didn't have success. It may have been that you have the wrong goal. So, you know, when we're looking at, I just wanted to clarify that a little bit. But for us, it's really, really important for us to look at that. In terms of like marketing, right now we don't do any like external marketing for campaigns, but it's something that we're thinking about.
Okay.
I think that was
your question.
Avi started the day by talking about the
Why is it a good thing for the entrepreneurs? Very easy for me to understand. Why is it good for the platform? Very easy. They take money from the top. What's less clear to me is why is it good for investors? Let's say that I'm talking just investment to make money, or the illusion of making money. And the question is it like an alternative to be an angel investor, which people can do, or is it really like buying a lottery ticket, which means I expect to lose 50 cents on a dollar when I buy a lottery ticket, yet some people buy one or more every week with the illusion of making money maybe, but not based on scientific evidence that money gets made.
So I break this down very specifically between reward-based and an equity funding platform. So if you're participating in equity, you should be making money. You should look at it as an investment and evaluate it as an investment. If you're doing reward-based, it's a reward. So you get something. I don't even call it you're making an investment there. You're contributing. You're backing something, but that's not an investment. I draw a very clear line.
Yeah, I mean, I think about it. I think about it basically like I had in my slide. The way we envision the future is, from an investor's perspective, you get to participate. And if you contributed to the campaign when it was nothing, you get to participate when it could be something, because you've already made a bet in their product, right? Now this levels the playing field, so now you can make a bet in their company, which before wasn't the case.
Okay, with the comment that our two practitioner members made actually some remarks that have a very strong theoretical academic backing, I'm going to say that we've reached the end of a fantastic conference. Please join me for a round of applause for Anindya. And for the person who did the real work, Mandie Osborne. Stand up, Mandie.
Also, I'd like to thank Erin. Erin, stand up. All right, thank you, Erin. So there's one last piece of good news, which is that if you make to the PB's bar, we're going to have drinks. Is it one free drink?
Yeah.
Okay. So we'll have free drinks and PB's.
See Erin when you get to Cremades, because she has your free drink ticket. Erin, wait. Thank you for coming.
Thank you. Indiegogo has been extremely kind to me, so thank you.